So we'll start with the new standard, very beautiful, small, cute, loving, you can call again. Doesn't take much time also. And tax is by default you love. So we will see this income taxes in days 12. So before I proceed, see, you accidentally touch one lamp, say fire. What happens? Instantly you remove, no? In this process, do you know how many steps are involved? Literally, there are 7 to 6 steps involved. Like your fingers will feel, oh, there is a heat. This message will go to your backbone through nose. Nurse will send it to the brain. Brain will try to figure out what it is. And from there, it will realize, oh, this is a pain. So I have to tell the finger to come out, come back. And it will send the instruction back to you and say, remove your hand. You know how much time, how much steps, how much processes. Literally so many activities are involved, but you don't realize, no? You just take it out. If I go into the deferred tax, it is something very similar. There are 10 steps. If you have to solve any deferred tax related question. But it should happen so fast that 10 steps should get processed in your mind so fast. Just like you take out your finger, no? By looking at the problem, you should be telling, oh, what is the deferred tax? Like I said, 2 plus 2. You need not tell, it strikes to you like that, no? Like this, we will learn about this deferred tax. Okay, so these are all the things we are going to cover. Certain advanced things like revaluation, we have already understood now. PP, we have finished. Consolidation part is there, that okay, that's we will see. Because without this, I cannot touch the consolidation. That's why some portion of consolidation I will discuss. Tax reconciliation is something new. And ESOPs, so we have learned. One question is there, and there is one exception also. Let us learn how it is applied there. Yes, and if you think this income taxes is really connected with our Income Tax Act, the answer is no. We are learning one discipline, okay? Discipline name is called accounting. And when we talk about one discipline, we literally don't touch others' discipline. So somebody doesn't need to have that knowledge. Okay, what you need to have is little basic knowledge. Have you calculated income tax? Obviously, at the inter-level only you must have done profit, add back, disallowed expenses. You know that much, enough. Like what exactly is happening right now in the Income Tax Act, that is not relevant for you, that is not important for you to understand this particular subject, this chapter. Now, we are going to talk about theoretically, because that revaluation and consolidation is only a matter of questions. Now, you must have learnt earlier deferred taxes. Okay, that must be a P&L approach. Like you must have done at the intermediate level. But what we are going to learn is a very simplified approach, and that is called a balance sheet approach. It's a very simple approach, no headache. Okay, I told you, look at it, you understand it. Now, before we proceed into, we should understand what is the logic, why we need to provide the deferred tax. Say, I'll give you certain examples so that you understand this example, and just pay attention, because first portion of what I'm going to explain, it is really very important for you to solve every single problem, at least the 10 steps what I'm going to explain. Now, say for example, you have purchased one asset whose cost is 100 and it is depreciable for 2 years in the books. Say for example, 50 years in the first year accounting, 50% in the second year. But it is a special asset and 100% depreciation you are going to get in the first year only. Now let me prepare the P&L account. I prepare the P&L account. I get the profit this much, say whatever, EBITDA or whatever. I deduct the depreciation 50 and I'll get PAT 50. Now I need to calculate the income tax liability. So for this, I will add back the profit, whatever I have claimed in the P&L, and I will deduct the depreciation as per tax. So what is my tax liability? 0. I'm happy. But that happiness will not last long. The very next year when I made, say for example, I made the same amount of profit, I claimed again depreciation. This depreciation got added back and I didn't have anything to claim. So my taxable profit became 100 and on that 30 rupees I paid. if we observe this very closely, see, on one side, I maintain a conservatism, I'll maintain accrual system. But if you see one of the expenses, you are accounting on a cash basis. It's a cash basis, no? Like you paid, you claim. How come? Now, this creates a volatility. See, the moment you go for a cash basis of accounting, it is a volatility for your P&L account. 1 year, no profit, no taxes, bumper profit. Okay. Accounting profit is same. But if you see the tax expenses going to eat, if I look into the, what is my PAT? First year PAT is 50, second year PAT is 20. You're clear now? So now, certain reversible deductions are there. Now, why this came? Because of certain reversible deductions. Now, there is a tax liability in the upcoming years. Okay, so like for example, because of certain reversible deduction, you have got a liability. Book value of the asset is 50, tax base is nil. Now, 100 rupees cost minus 50. This is called book value. At the end of the first year, if you go and look at the balance sheet, what is your book value? 50 rupees. If you look into the income tax records, see, you don't maintain 2 records, no? For income tax one, for accounts one, do you do that? No. What is the implication? If you maintain 2 books of accounts, you may get arrested. Followed, no? So, but that's why whatever you show, you have to show to the income tax also. Look, this is the thing. Then they will say, do these adjustments. Now, for my income tax, yes, my cost was 100 only because I told them, look, sir, this is my asset. Otherwise, that asset becomes one asset from undisclosed source. But I claim deduction, so my tax base becomes nil. So, we create a deferred tax liability now on the difference of 50 rupees. This is called a temporary difference at the rate of 30% tax rate on 15 rupees. So, my total tax includes income tax plus deferred tax. This is reversed subsequently as the book value of the asset is going to become 0. This is the logic. This is the simple logic for your deferred tax. Now, I will show you the effect. If you would have done deferred tax, how my P&L would have looked like. See, in the first year, this is without deferred tax. Already we have seen 100 rupees, 100 rupees. I claim accounting depreciation 50-50. So, my PAT become 50-50. So, since I didn't apply deferred tax, first year no tax, second year with the tax, 50-20 is my profit. But at the end of the first year, I knew because of certain deductions, which is not a permanent deduction for me. Otherwise, I would have said, look, sir, this is a permanent deduction. There is no tax implication in the future. But I know that this today's my action has got tax implications in the future. So, Ind AS 37 says, look, you have got a present obligation to be settled in the future. So, if with the deferred tax when I go, you see my PAT is 50-50, but when I deduct tax, you see the beautiful thing, my PAT is 35-35. Even though in reality I don't claim any expenses, I make a provision for a tax which I am going to pay next year. And when I actually pay next year, I take that 15 rupees from the provision of what I created last year, not out of I will claim as an expense. Because this 30 is what I pay in cash. And it gives me a cash basis of accounting. Have you understood the logic behind deferred tax? This is one simple logic, simple example. Now, so many items are getting mixed. Otherwise, we will not realize the effect of it, why we are doing it. One item, if we understand what exactly deferred tax is trying to tell us, then we realize it. So, what is important for us is deferred tax liability. Asset, you keep asset. You don't recognize also, nobody will tell you anything. But the liability is something we have to recognize because we are following conservatism. That is our top priority in deferred tax, not asset. Followed, no? Yes. Now, current tax and deferred tax. First, we will talk about the recognition and the measurement. Yes, since it is one of the leg is going to sit in the balance sheet, so recognition and subsequent measurements are going to happen. The tax expense. What is the tax expense? Which is charge in the P&L account is the aggregate of current tax and deferred tax. The standard says, look, what you show in the less taxes you do now after PAT, it should not be only current tax. It should have deferred tax also. That means you have to calculate deferred tax. Now, it is the future tax consequences. That means what is that deferred tax? Deferred. You pushed it right now because of certain reductions, and the consequences are going to come in the future. If there are no consequences are going to come in the future, it's not my deferred tax only. No, you just ignore it. How? Because of the recovery of the assets. That means any assets in the balance sheet, eventually you take out of that asset. No, you take that balance sheet out of the balance sheet. Why? Because none of the asset can remain asset forever. You have to take out. You tell me any balance sheet assets, because as time passes, everything including us will get finished off one day. Parental happens. So when you take out that asset from the balance sheet, is there any implications of tax? That matters. If answer is yes, yes, it is the subject matter of deferred tax. When you take out that asset or liability from the balance sheet, if the answer is no, it is not a subject matter of deferred tax. Simple logic. Now, how do you recognize the current tax? Standard says simple. Whatever unpaid current tax is there, it should be shown as current liability, because you are going to settle it within one year from the end of the current year. And whatever current tax liability and whatever expenses are there, you are going to claim it as an expense. Current tax liability shall be measured at expected to be paid to the taxation authorities. Like maybe tomorrow they may add back more things, and one order comes. Then if I know that they are going to add it back, then better provide more liabilities. Finish. We don't have much headache. There is nothing much calculations. It's a very simple thing on profit, whatever adjustment, add back adjustments you do. Tell this is my current tax. Finish. This is what we have done. We have learned at the at the inter level or BCom level. Now comes the deferred tax concept. I told you the concept of deferred tax under new Ind AS is a balance sheet approach. Very simple approach, lovely approach. Now, what are the 10 steps involved in deferred tax? It starts with the computation of the book value, which is already there in the balance sheet. No, what is there? So ignore it first. The heart of this deferred tax is the computation of the tax base. You have to understand this logic very well. No confusion, because if you get confused once, you will remain in the confusion only. So we will spend maximum time on this tax base. Then computation of temporary difference. We can call maybe first standard or second standard student and say this is. Calculate the temporary difference. Any first standard or second standard student will do. It's a finding out the difference between the first and the two. Classify the difference. Here again we are needed. Whether it is a temporary deductible difference or a taxable difference. Identify certain exceptions. Okay, they have told certain exceptions when you should not calculate it. Assess the deductible. If it is a deferred tax asset, then you have to apply 3 conditions there. Tax rate you determine, very simple. Calculate, multiply with the tax base difference. Account it, pass one accounting entry. Accounting entry is like similar to your derivative. Only 2 entries. What headache? No headache only. Only 2 entries. What is that? Like derivative, we have got loss to derivative liability, derivative assets to gain. Similarly, we have got only 2 entries. It is deferred tax expense to deferred tax liability, or deferred tax asset to deferred tax income. And last is the offsetting. We cannot show like PVDBO and plan assets. We cannot show 2 separate. No. Like the standard says, your deferred tax asset and liability has to be offset. Okay, first thing, computation of the carrying amount of the assets and liabilities, leave it. We will do it as per the next step. Yes, now onwards, it's a very important thing. Please understand how to calculate the tax base. For this, you need to be little imaginative. You have to just imagine about the balance sheet of the income tax. Balance sheet, because we are going with the balance sheet approach, not with the P&L approach. So, and keep in mind, I cannot maintain two books there. Suddenly raid happens, they will ask, this building belongs to whom? I say it's my building. Immediately they will take out the balance sheet and say, show me, where is your balance sheet? When you filed my return or tax audit return you filed, did you attach one balance sheet? Yes. Have you shown me in that? If you say no, then that means you maintain two books of accounts. One is for your personal purpose, another for income tax. That's not permitted. So when you file the return of income and you must have attached a balance sheet, in that you should have disclosed this. Okay. Let us take certain example one. The cost of the asset is 100 rupees, say PP. Life is 10 years and IT depreciation allowed is 30%. Now, my book value I will tax base. Like this, I'll give you 16 examples, okay? You have to be very clear. Whatever doubts you want to ask me now. Because later, if you have understood, you will not ask me any doubts. It will smoothly flow. Now, my cost is 100. Is this cost shown to tax also? Yes, you would have shown him. But how much depreciation you claim? 10 rupees, because life is 10 years. How much depreciation allowed by the income tax department? 30. Why? Because they added back your 10 and allowed 30, because their tax rate is 30%. So, what is the closing balance as on 31st March of the first year? Book balance is 90. But if you open income tax department's records, they say, no, Baba, your book balance is not 90. Your book balance is 70 as per us. So, this is called a tax base. Are you clear? First one. Very clear, no, everyone? Yes. Let me take one more example. The cost of the asset is 100. Book value is 80. You have revalued to 150. Oh, PP, we have done this. Where it will go, that excess? How much? 70. Now, till now, 30 rupees depreciation you have charged. Same, opening. Now tell me, is that revaluation is recognized by the income tax department? Are you supposed to pay tax? When you are supposed to pay tax? That means I am never supposed to pay tax. On the date of sale, you have to pay tax. That means it becomes a cash basis of accounting. No. But it's a temporary difference. So, your book value was 100, for tax also 100. You claimed a depreciation of 20. They added it back. And you added a 70 rupees revaluation surplus, which income tax department said, no, Baba, I am not going to recognize it right now. So, my book value is 150, but as per income tax records, how much? 100 was there. They allowed you only 30 rupees deduction, and 70 rupees they didn't recognize only. They say, simply because you redo revaluation, don't pay tax right now. Then everybody would have gone for a cost basis of accounting. We say revaluation not required. Unnecessarily, no, you revalue and pay tax there. So my tax base becomes 70. Are you clear? Any doubts? I have taken it to OCI, no? Now see, that's what I'm telling you. When you are studying right now, you need not really think what income tax is telling. Followed, no? You have to look into the question what they have told. Now you have to see whether the revaluation surplus is allowed as a deduction or allowed as a taxable or not taxable right now. In the question they would have told, no, it is allowed taxable on cash basis. That means only when you sell, then it is taxable. If at all they would have told that the whatever revaluation you recognize right now you have to pay tax, then 70 rupees you would have added here and your tax base would have become 170. Followed, no? Then it will result into deferred tax asset now from deferred tax liability. Now, why? By looking at only I can tell it. Why? There is one logic. As we proceed further, we will see. It is not required right now. When deferred tax asset comes, liability is going to come. But now let us only focus on tax base. Are you clear tax base? Why tax base is 70? Yes. Entity sold on credit, 100 rupees. What accounting entry you passed? Debtor to sales. In this, which item is sitting in the balance sheet? See, we are going with the balance sheet approach. Sales, P&L item, we are not looking at it. In the balance sheet, debtor is sitting at what value? 100. Have you presented shown that debtor to income tax also? Yeah. When you will not show? Suppose cash sale happened. That you may not record on your books only. Followed? No. So we are not doing that. What we record is what we present. So the debtor is presented here. Debtor is presented to the income tax department also. Now, 12-month ECL is 1%. What is this 12-month ECL? What is the full form of ECL? Expected credit loss. You remember, no? We will not call it bad debts and all. We'll speak in this language only. Anybody. Is a lifetime expected loss ECL. That sounds very nice. 12 months ECL is 1%. That means in books of account, you passed any accounting entry? What accounting entry you passed? Provision for bad debt? To debtors. So you deducted that debtor and your book value at the end of the year you showed 99. Now question comes, did that income tax department allow that bad debts provision? No. What did you do? Add back. Will they allow? Ever? Yes. When? Only when the bad debts are provided. When the bad debt happen, you claim. Now this becomes one temporary. This add back is only a matter of time. Tomorrow if you really don't pay, I'm going to claim money from you. So they added it back. That means they didn't provide you deduction. So what is their tax base now? How much debtor is sitting in their balance sheet? 100. Perfect. No doubts? Things are very clear? Okay. Now let me take one more thing. A Limited has invested 100 rupees, which is a 20% stake in B Limited. And you have exercised significant influence. Now the profit earned by B Limited for the year is 10 rupees. Now which method of accounting you are going to follow? Since you have got a significant influence, you will follow one equity method of accounting, which we will learn now. Somewhere you must have learned associate accounting, in it was there now. What you do, whatever profits they make, 20% of that you will pass accounting entry in your books of account in consolidated, not in standalone. But what income tax says? Income tax laws, profits are recognized under equity method of accounting are taxed only when it is distributed as a dividend or the investment is disposed of. They say that, look Baba, in your books of accounts, you purchased one asset. Did you show to income tax? Yes. That's why your investment is 100. For tax base is also 100. Now what accounting entry you passed? You passed investment account debit to share of my profit from my associate. Chalo. Did you pay tax on it? No. Income tax department said no, add this back. Okay, sir. That means, will you never allow me? Yes, I will allow you. Okay, I will tax this. Okay, not add, you deduct. Deduct this. They deducted it, no? You showed it as an income. What is your accounting entry? Share of profit. Investment account debit to share of profit. Now, on this, did you pay tax? No. Did you add or deduct? When income tax calculations you are doing, did you add or did you deduct? Expenses are added back, no. Non-taxable incomes are deducted. So, they didn't recognize it only. They say, no, whatever you do in the balance sheet P&L account, I am not going to recognize it as your income. You pay tax on this if they distribute dividend. Or tomorrow, if they don't distribute dividend, what is going to happen? Your cost will remain cost only. Because in AFM, we have learnt one function, this thing, what is that called, one principle. That means there are only two things. If somebody pays you principal plus interest from time to time, only your 100 rupees principal will remain. Somebody you have invested 100, no interest is paid, 180 rupees they will pay you. That's the only two options possible. That means tomorrow when you sell, this dividend is sitting, undistributed dividend is sitting as one accumulated capital appreciation. You pay tax then. So what is your tax base today? See, your book value is 102. Why? For 100, you have added profit, but your tax base will remain 100 only. Are you clear? Why? Because they don't recognize it. They say, now you don't pay tax, you pay in the future. Clear, Vidya? Sure, no students? Everyone? Dhanush? Perfect. Okay. Example 5. X recognized a provision for plant closure. What accounting did you entry you pass for plant closure? Have you come across this anywhere? Any chapter? Yes, actually it is the Ind AS 37. But you remember termination cost of Ind AS 19? One accounting entry. Debit what? Plant closure cost. You have to make a provision now. What is the debit? Plant closure cost. What is the plant closure? Means you have decided you will close the plant. So you will make a provision for certain expenses. What accounting entry you pass? Sorry? Loudly. You call it by anything, Baba. Liquidation expenses, closure expenses. Debit what? P&L. Credit? Provision. So in this, any item is sitting in the balance sheet? Yes. Okay. Which is that? Provision. Now what is the book value of it? 100. Now question comes, when you claimed this, did the income tax department provided you the deduction? Did you add back? When they say pay on cash, you claim the deduction. So when you recognize this 100 rupees, they say no, I'm not going to recognize this. They didn't recognize this. So their tax base is nil. Clear? Now, X Limited capitalized the development cost of rupees 100. The moment as per Ind AS 38, your research and development. Research cannot be capitalized. Development only can be capitalized. 100. Now, the life of such intangible asset is 5 years. But as per IT law, this cost is fully deductible in the same year. Now, when you incurred for the first time, what accounting entry did you pass? Development cost. What accounting entry did you pass? Asset account debit to what accounting did you pass for development cost? Asset to bank. Now, when you passed this asset account debit, did you show it to the income tax also? Yes, obviously, no, you have to show. So always first entry will reflect both the places of balance sheet. Now, how much deduction you claimed? Sorry, okay, actually it is 100 here, development cost. How much deduction you claim? 20 rupees. How much deduction they allowed? 100. So what is the tax base? Nil 80. Okay, I should have written here 100, followed, no? I'll change this. Now, now your favorite. Now you have to tell me. Okay, everybody has to apply your mind. X borrowed interest-free loan of rupees 100 for 3 years. This is repayable after 3 years with the single payment of 130.44. What type of loan it is? Zero coupon bond. Now, EIR is 10%. What for? What for? What is that EIR for? Amortization. See, remember, when I ask you something, just you have to get connected. EIR meant for amortization, simple. Transaction cost is rupees 1. How do you account this transaction cost? Deduct from the loan. Why? How you are going to classify this loan? How you are going to classify this loan? So you said transaction cost, you are going to deduct. That depends on what? Classification. What is the classification of the loan? Why? Why? Holding the loan for payment. Principal is SPP attested is going to pass. That is for whom, Baba? Asset or liability? That test is meant for asset, no? Did you borrow or did you give? Borrow. Is that test applicable for a classification of a liability? Then what test is applicable? You should tell, sir, it's a financial liability. Financial liability default classification is amortization. Nice, no? I'm telling you, see, like this you get their application later, students. See, if you don't read that, you'll never appreciate when it comes in the deferred tax. So many places you'll come across now, OCI, recycling, okay, tax implication of that recycling. Now, income tax says, look, whatever transaction cost you paid, it is fully deductible in the same year. And the deduction of 30 rupees 0.44, what you pay, no, what is this 30.44? Interest, no? You claim when you repay it. Now, can you tell me, please pause the video, students, and tell me what is my, at the end of the first year, what is my book value and the tax base? Yes, students, please pause the video and tell me what is the tax base and the book value. Yes, students, so everyone will say that book value is 108.9 and tax base is 99. Okay, let us see now. Let us check your answers. First thing, when the transaction price is included, it is at a fair value or off market transaction it is. Is it at market or off market? At market. So you would have recorded it 100 rupees only. Then what you did? You deducted the transaction cost, you got 99 and you added 10 rupees and you say 10%, 109. Yeah, 108.9. I am rounded it off to 109. But when it comes to income tax, see, when you took a loan, did you show there? Yes. Did they allow you this as a deduction? Yes. So they never adjusted to the liability. No? They permitted you deduction there. You adjusted, you passed one accounting entry. What was the accounting entry you passed here? Loan account debit to transaction cost. What accounting entry they passed? Income tax. P&L account debit, because they permitted it as a deduction. No. They didn't touch this loan. They permitted you as a deduction for the expense or profit of the year. So their accounting entry is expense account debit to transaction cost or P&L account debit to transaction cost. They recognize this in the P&L account. You recognize this in the balance sheet. Then you passed one more entry. Interest expense account debit to loan. Did they recognize it? No, they said reverse it. They didn't recognize that entry only. So your tax base will become 100. Are you clear? Anything, any doubts? Yes, what is the doubt? The transaction cost, what you paid, no, transaction cost account debit to bank. You touched or you adjusted with the balance sheet item. You capitalized it. You capitalized it. But they didn't permit capitalization. That's why, since they didn't permitted the capitalization, their balance will remain whatever was there at the beginning. But your balances will change. So on day one, the tax base is 100, book value is 99. On day one, when I asked you, what is my day one book value? My day one book value is 99 and tax base is 100. Tax base will remain 100 only. Are you clear? Yeah, because whatever you passed an entry, they added back. What do you mean by add back? Add back means reverse. Simple. That means what entry? Like if I go to that first example of asset, add back depreciation as per books means what? Whatever entry you pass, no depreciation expense account debit to PP, they say reverse it. That means you revert back to your original cost of the PP and they say claim 30% as my deduction. That means you pass one new accounting entry only for income tax purpose. Yeah, because there is no tax implications on this interest, no? Right now. Will you pay tax on this? Or will you claim a deduction? You don't claim because you add it back. This interest expense, you will be adding it back in your tax calculations. We did, yeah, no. When we are not paying now, no, we pay 130, no, later. Like this, 3-year interest will come. And yeah, No, transaction cost when you have deducted, what happened? No, your interest cost increases. No. So the transaction cost, in fact, they will also permit you expense deduction, but it is adjusted here in the EIR. Followed, no? Yeah, please students think, ask me example. This is most important because again I'm see. In fact, what is this example? No, all your study material questions. So if you have understood this very well, then my problem is done. No. So in fact, I will tell you only solve it now. Every problem sketch I have taken here. So example 8, X entered into a lease contract for a machinery for 5 years. This also you have completed. Annual lease payment is 30 rupees payable at the end of the every year. The present value of the lease liability is 120. Implicit rate is 8%. But the tax law permits only lease rent payment. Question clear? What happened here? Here you are paying 30 rupees every year. For how many years? For 5 years. Its present value comes to 120. What accounting entry you do pass? Huh? Okay, when the accounting entries will come into picture? You pay at the end of the year. Will you pass the entries at the end of the year or at the beginning of the year? Under lease index 116. It is lease, no baba. Lease contract is governed by 116. What your 116 says? Whatever lease rent you pay, I don't consider it only, forget it. It is a cash flow for me, it's not an expense. Instead, what you should do? Find out the present value of the lease and pass one recognition entry at the beginning. What is that entry? ROE asset account debit to lease liability. Followed, no? But did that entry recognized by the income tax department? No, what did they say? Reverse. For me, if you go and tell, come there, they look in your balance sheet, what is this? So it is an ROE asset. Leave ROE asset. Because if they recognize, then they have to give you deduction for your depreciation and interest expense. Will they give you front load expense? They say no, front load, because they say that look, if you follow this methodology of lease liability, it is like a front load expense recognition pattern. Initial years you claim very high expense. Income tax says no baba, your accounting concepts are very fantastic. What you are going to tell to the investors is very fantastic, but in this process you end up getting high deduction at the beginning of the year. I am not going to permit it. I will permit you simple rent payment SLM basis next 5 years. So this creates one temporary difference. Are you clear? So if you look into the ROU asset, what is my book value? 120. Did they recognize it? No. What is my depreciation? First year 24. Did they recognize it? No. So my closing balance is 96. My tax base is 0. Tax base means in the tax balance sheet, there is nothing called an ROE asset. Because every year, whatever rent you pay, you have claimed it as a deduction. It is hitting P&L account. Rent portion? No, we are not charging in the P&L only, When we follow this lease liability accounting, there is nothing called the lease rent expense account. There is only two expenses called interest expense and depreciation expense. And both are added back by the income tax department, telling, look, that ROU depreciation, God knows, 150 shares that you have created, and on that you are claiming depreciation. I am not going to permit this. You have paid 150, you claim that as a deduction. Since they say, I don't recognize your ROU asset, and means whatever entry I have passed in my books, I should reverse it. See students, the underlying logic is like this. What I am trying to tell you, when you pass any entry in your books of account here, automatically should come here also, first time. Because you cannot maintain two books of accounts. But if income tax says, no, I don't recognize this entry you passed, literally I have to reverse it in income tax and I have to pass accounting entry the way they say. They say, look, your ROU I am not going to reverse. So you credit ROU. Debit liability. That's why liability also don't have any tax base. I claim depreciation. You say add back depreciation, add back expenses. Then I look at it, sir, then what about this lease rent I'm paying? You claim that as a deduction. But lease rent payment deduction has not got no balance sheet effect there. But all these add backs will result in my differences in the balance sheet. That's why my tax base becomes zero for ROE asset and lease liability always, because they never recognized it. But I will always have a balances in my balance sheet. So the net difference is going to create a deferred tax. Are you clear? Yes. K purchased an equity shares of 200 rupees. Now you should tell me, dear students. K purchased the equity shares of 200, which is designated at FVOCI. You corrected immediately. Option was there. Now at the end of the year, the fair value is 240, and as per tax they say that when you have to pay capital gains only when you sell. Now what is my book value end of the year? Book value. Okay, I will start. See, I purchased at 240, no, 200, no. So I will say that this is my book value. This is my tax base. What is my book value at the beginning of the year? 200. What is my tax base at the beginning of the year? 200. Did they say no, I'm not going to recognize this? No. Then you, at the end of the year, the fair value was 240. What accounting entry did you pass? Equity, that's fair valuation I'm going to do now. Fair valuation, equity is subject to fair valuation. Why? Why? Why equity shares I'm going to classify, I'm going to revalue, fair value it. Why don't I amortize it? Why I do that? Yeah, fair valuation means mark to market. Why I don't amortize equity shares? In interview, if you are asked this question, tell me, student, why equity shares are not amortized? What is your answer? Sorry? Sorry? Okay. Yeah, I want to listen to you. See, possible, no? Possible, students, can this be an interview question? The moment you qualify, go for campus, they may ask you this. Sorry? Okay, tell. You're coming close, but not exactly. Simple, your answer is only one thing. Sir, we do the fair valuation because this equity investment is a financial asset and that fails SPPI test. Simple, finish, and matter close, interview done there. If you tell something different, no, the point is very clear, students, that means you are not able to go and connect there what they are asking. It fails SPPI test, no. That's why equity shares by default will land up in FVTPL. Business model test, there are two tests applicable. You look at business model, provided it will pass the SPPI test. Are you clear? Now, but you have got an option for equity shares. That's why they opted it. That's why they said FVOCI. You look at the connection, how it comes. Perfect. And see, without understanding this, and if you say I will provide deferred tax, I don't know how it sounds. Means to provide a deferred tax, you should have understood the accounting there. Then you understand and appreciate the accounting. Okay, now tell me, when you classify, you do a fair valuation of equity instrument at the end of the year. Equity investments, huh? Okay, why don't you do fair valuation of your equity? In equity investments are your financial assets. It will end up in FVOCI or FVTPL. What about your equity investments? Your equity instrument? What you issue? Are you going to do the fair valuation of it? Why? Because your equity instruments is not a subject matter of restatement. That we have seen in India's 102 also. Once equity for always equity. It is not something liability for you. It is with you. What is the point? Like, see, something is there with me forever. Like I have got a land which I am not going to sell. It's with me forever. Why I should go and check the market price of it, Baba? It's there with me forever. No. Followed? No. Like, am I looking for job? No. No. Some call comes, I say I am not interested in the job. I left my job. I am not going to go and update in the Naukri.com. Why? Because I am with something and I am feel that I will live with this forever. So that doesn't feels good for me. It doesn't make sense to me. Fair valuation. Anyhow, now when you do the fair valuation of that equity, what accounting entry do you pass? You have invested in the shares, say MRPL, which is an FVOCI classification. And when you do the revaluation of that or fair valuation of that MRPL shares, what accounting entry you are going to pass? Investment to FVOCI reserve. So that means, are you going to add this FVOCI reserve 40? My book value becomes 240. Now question comes, when you have added it and recognized one income, did the income tax department also taxed it? No. What did they say? Not now, in future when you sell this. That means you literally reversed this. They didn't recognize it. So at the end of the year, the tax base will remain 200 only, but the book value becomes 240. Are you clear? Vidya? Perfect. Now, X sold goods to 100% subsidiary S Limited. Look, one more thing. Yes, at this point of time, don't expect much. But okay, since you must have been having consolidation at the intermediate, S Limited, P Limited is the parent. They sold goods of worth costing 80 rupees to their subsidiary. And the cost of the goods is 64. So how much profit parent made? 64 minus 80. 16 rupees. By the end of the year, S already sold 40% of the goods from its parent to some third party. Now, there is one element of unrealized profit because we are going to consolidate now. Followed, no? Now, what is the book value of the unsold inventory in the consolidated financial statement? See, first of all, out of 80, you will remove that profit cost because me and my kids are not different, no? Can your parents say, sold through you and made a bumper profit? Or you purchased something and I made a bumper profit? That doesn't happen with the parent and child relationship. It happens with the third party. Followed, no? So, 64 is ultimately you're going to, suppose if this stock was never sold, 100% is remaining with the subsidiary, in the balance sheet at the end of the year, which we will learn in the consolidation chapter, 64 you would have shown. But out of that, 40% is sold, no? So, what is my book value of the inventory at the end of the year? 38 after unrealized profit elimination. But the income tax department will say, look, Baba, your parent, your subsidiary, your consolidation, all stories keep with you. Where the stock is lying? With the subsidiary. At what value they brought? 80. Now, in this, now you tell me some story, unrealized profit and all. Now you don't tell me. Out of 80, 40%, 60% is there in the balance sheet, no? So, for me, the book value is 80. Income tax department will say. So, that is why tax base becomes 48. Are you clear? Now, K Limited received 200 rupees from the customer for services yet to be provided. Again, but 115 concept. What it is? What accounting entry you pass? 2. You received 100 rupees advance from the customer. What accounting entry will pass? Bank account debit to advance from the customer. Okay. Did you show this advance from the customer to income tax also? Yes, they showed you. Okay, this also I need to show. 200 rupees is the tax base. On day one, what entry you pass in the books? You tell income tax also. Don't do that, a mistake. You passed one entry and income tax, different thing. That means you are maintaining two books. Now, how much you revenue recognize at the end of the year, you provided service worth of 120 rupees. What accounting entry you passed? Advance to? You will not pass only. Advance to revenue, no, 120 rupees. You will reverse that advance because there is no more advance to you. It is your income to you. So at the end of the year, if I go and look into the balance sheet, how much liability is still sitting? 80 rupees. Now I'll go to the income tax records. When I received that advance, they showed me, correct, 200 rupees. But what income tax said, no, look, whatever, for me advance, whether you rendered service, not rendered is not relevant. The revenue is taxable on receipt basis. 200 you received, no, right now you pay tax, finish. Next year you give service, that is next year's story. Right now you have to pay tax. In that case, they fully 200 rupees I paid the tax right now. They gave me full 200 rupees deduction. At the end of the year, tax base is 0. Perfect. See, H Limited has got an inventory of 100 rupees against which they created a provision for inventory obsolescence. But the income tax, they said this is not taxable. Easy. Book value you had 100. You made a provision. You added it back. They didn't permit you. So at the end of the year, 90 and 100 is the tax base. Sorry. Bank to customer advance. Yeah, customer advance is sitting in the balance sheet. At what value? Right now, at what value it is sitting? 200 rupees. In income tax, how much it is sitting? Same, 200. At the end of the year, how much I claimed in deduction? 120. So my closing balance became 80. In income tax, how much deduction I claimed? Full 200. Because they said pay tax right now. No, so it is not a balance sheet item anymore. See, 200 rupees you received initially. Income tax said, look, 120 I don't recognize it. Reverse it. You went back to the original. Correct? Now, what accounting entry income tax said? If you have to pay tax, it should be on revenue, no, or it will be on advances. Revenue. What accounting entry you must have passed in income tax? How much? 200. That's what. That's why advance to revenue 200. So you deduct full claim deduction of 200. That's what they didn't permit. No, if at all they also permit the same thing, then see, I'll tell you. I think somewhere I told also before. The day may come where they say that, oh, your accounting profit is a very fair profit. Do one thing, pay 30% tax on that, finish. That day, your specialization called income tax will go. Followed, no? There's nothing called a specialization. Because that day life become very easy now. Whatever profits you can, then specialization of accounting is going to come. Whatever, and where is the question of deferred tax? Because this is a profit, is an accrued profit, you pay 30% tax on that, finish. But that doesn't happen, no. All so many adjustments are there. Are you clear now why we are deducting 200? India. See, when you receive the advance for the first time, you recognize here also, you recognize here also. Same entry. Then you pass one more entry. Advance to revenue. But income tax says no. That entry I will permit, but not for 120, for full 200, because you have to pay tax right now. That's what I told you, need to imagine that. In reality, it doesn't work like that. You maintain records there, separate records. But what I'm trying to tell you, in terms of accounting entries only, I'm trying to explain you what happens there. So that the tax base becomes 0. Yeah, that's what they said. No, tax loss, revenue is taxed on receivable. That's what I'm telling you. You need not really know what is income tax right now. That is required for your paper number 4. What is that? Multidisciplinary. There they may not tell you. I don't know. May not be immediate also. There you may be expected to know income tax, what income tax is telling. But right now, for this subject, it is not relevant for you what income tax is telling. What question is telling that you need to see. Because we are learning a discipline, not a multidiscipline. In a discipline, what happened now? We never touch others. Generally, we have got that impression, oh, sir, income tax is telling me something different, security transaction tax is coming. Keep it aside, no. We will talk only here, no, accounting part. Now, example number 13. Okay, 3 more examples. Yeah, very important, because with this, you should get a fair idea how it works. Then rest of the things are like this child's play for you. This is the one which is the heart of this chapter. Received the government grant of rupees 100. You see the speciality here. Here there is little difference. Entity recognized it as a deferred grant. Now, Ind AS 20 is going to come at this point of time again. Don't expect you to know everything. Now, when you received the grant, there are 2 types of grant as per Ind AS 20, revenue grant or a capital grant. If it is a revenue grant, what accounting entry you pass? Bank to P&L. Finish. Is there any item sitting in the balance sheet? No. Balance sheet item is not there, means no deferred tax. Keep in mind, we are going for the balance sheet approach. If in your journal entry, balance sheet is not there, no deferred tax. Now, you passed one accounting entry. What accounting entry did you pass? Bank account debit to deferred government grant. So, book value, deferred government grant, 100 rupees came. Did you claim any deduction during the year? Say whatever, yes or no. Let us say, for example, we didn't claim any deduction. We want to claim it after 2 years from now. Why? Because government gives some conditions. Ind AS 20 says that unless those conditions are fulfilled, you cannot claim. So at the end of the first year, what is my book value? 100. Okay, now first question comes. Did the income tax recognize this entry? Did they recognize? Yes. Did they permit? No. That means this doesn't have any tax effect in the future. This is not taxable only. That means tomorrow when you claim it, income tax will never give you any deduction for it, or income tax will not charge you tax on this also. That means this becomes a permanent difference. So your tax base also will remain 100. Chalo, for example, today you claim, this year you offered 10 rupees for income. Your book value became 90. Followed, no? Then what is your tax base? 90. Why? See, something which is not having a future taxable effect, then don't apply this logic, because it becomes a permanent difference. In that case, the logic says your book value is equal to tax base. If you have claimed 50 rupees deduction, you say my book value is 50. Tax base is also 50. Don't go with the accounting entry logic there. Why? Because this is never deductible for income tax in the future. It is not a temporary difference. It's not that today I have permitted for income tax, tomorrow I will not permit. Tomorrow you will claim for accounts. Or today I have claimed for accounts, tomorrow you will claim for income tax. This is not like this, no. It is like I will claim today in accounts, but never in income tax, like fines and penalties. I will claim in accounts. Income tax will never permit me. That's why fines and penalty payable is not a temporary difference, it's a permanent difference. So the moment you get a permanent difference, always and always, BV is equal to TP, simple. Are you clear? Now, X Limited created a provision for PVDBO. Oh, then one more thing, see, nice, no? More you learn different standards. Beautifully, it should get interconnected. You made a provision for a warranty cost or PVDBO. Provision for warranty comes from Ind AS 37, PVDBO comes from 19. What accounting entry did you pass for PVDBO provision? Sorry? What accounting entry did you pass for making a provision for PVDBO? What expense it is? Employee benefit expense? Current service cost. Okay. Anyhow, you can call by any name. Your accounting entry is current service cost to provision. In that, any item of the balance sheet is sitting? Yes. How much? 100 rupees. Did you recognize there also? Yes, 100 rupees. Now, what is the tax base of the liability? Okay. Did you claim this? You made a provision. Did the income tax department provide it? No, they said, I will make you provision only on the claims basis. That means they asked you to reverse this. So at the end, the book value is 100, tax base is 0. They said, whatever current service cost you have claimed, no, present value of that future payable and all, I am not going to recognize. In 2040, whenever he retires, he will claim one payment, no, lump sum payment. I will allow that as a deduction. Is it a temporary? Yes, temporary. So I am going to reverse whatever entries I recognize because no expenses are recognized. Same, I think we have done this similar previous. Example 15, X limited creation provision for fines and penalties. Look how this is different. 14 and 15 are different. These fines and penalties are not deductible only. That means 100, 100. When something I encounter with a permanent difference, BV is equal to TB. Okay, the last example, X limited incurred preliminary expenses of 100 rupees. What accounting entry you passed? Which is charged to the revenue very first year of the accounting. That means expense account debit to bank. But the income tax department is giving deduction in 5 years. That means my book value is 0. Why? No balance sheet item only. My entry is expense account debit to bank. But income tax says, look, add this back. I will recognize only 20 out of this. So your book tax base is 80. Are you clear here? They say that, look, you claimed 100 rupees, no? I am not going to permit it. You reverse it. The moment reverse, then what about my back also again? That means my asset will be there, preliminary expenses. That means they have permitted me to capitalize it. And they will permit only 20 rupees reduction. So book value becomes, tax base becomes 8. Yes, Dhanashree, are you clear with everything? Yes, that's it. You are only 16 questions. Again, go through, students. You have doubt, you have to ask me. Yes, now what is the question of a permanent difference and a temporary difference? Whether any difference between the book value and the tax base, whether it is a permanent or temporary, depends upon when asset or liability is de-recognized in the future, does it has got a tax implication or not? Like you made a provision for fines and penalty. Fines and penalty provision is sitting in the balance sheet. When you remove it, will they give you a deduction in the future? No, no, it's permanent. So if no tax implication, permanent. In that case, BV is equal to TB. If there is tax implication, then it is temporary. Then CA is equal to not equal to TB. And TB, what is the value? You have to imagine now. Like you took a loan today 100. 120 is repaid after 2 years. Interest is on payment basis. Now loan at the balance at the end of the first year is 110. How come you got 110? 100 plus 10% interest. Now principal is 100, accrued interest is 10. Now when the liability is incurred, there is no tax benefit. When you took the loan, did you get the tax benefit on the principal? When you repay the loan, will you get the tax benefit on the principal? When you repay the loan, will they, on the principal, will they give you tax benefit? No, that's why the type of difference is permanent. That's why in every case, see, I used to explain in a different language. I used to always start with 100, 100. But if you see, this has got no tax implications. Another way to look at it. There are different ways to look at it. How do you understand it? Followed, no? I hope you are clear what I am trying to tell. Just a way to look. But interest is not like this. When the liability is incurred, there was no tax benefit because you are going to pay on payment basis. But when the liability is settled, you will get the tax benefit on payment basis. So this is the temporary. So tax base is not equal to book value. Then you do the actual tax base calculation. Yes. Now the next step, very easy step among all the 10 steps is, see, you calculated book value, you calculated the tax base, find the difference, it's called a temporary difference, if it is not a permanent. Yeah, but obviously, no, because if it is a permanent, then book value is equal to tax base. Then where is the question of difference there? So only temporary differences you are going to find out. Easy this time? Okay. Now comes another important part, but not that tricky like your tax base. Classify the temporary difference. Now whether this difference is a temporary taxable difference or deductible difference, because if you say it is taxable, deferred tax liability is going to come. If it is say deductible, deferred tax asset is going to come. The rules of classifications are like this, students, very simple. Very means, I don't know, how should I tell? If the book value is greater than tax base, it is taxable. Finish. Else deductible, liability taxable, deductible. So you have to just understand, remember only one. You have to remember only one. If for an asset book value is greater than the tax base, you have got deferred tax liability. Simple. Just remember only one thing. Other three things you can derive from it. For an asset, tax base is more than liability, deferred tax asset. That means deductible. For liability is ulta. Followed now? Now you should tell me, students, anyone here, what's the logic behind this? Have you understood why they are telling like this? No, if you follow this and remember and try to rote learn, no, that sounds like procedural learning. Higher amount of depreciation in the initial years or lower amount of depreciation in the, not initial years. Question is where? Books or tax? That's why there are different ways to understand this. Huh? You have to take one stand and try to figure out. And actually that much is not required. Look at the question, you say, oh, this is the thing. Yes. What is the logic? What are your ideas? Huh? Mm. Mm. See, again you are going to the income tax P&L approach, no? You are saying add back, my profit is more. Why you go for income tax? We look at it from the balance sheet perspective, no? Because we are talking carrying amount means balance sheet. Don't bring in P&L here. It's a very simple thing. Yes, Vidya, what is your opinion? Why carrying amount is greater than tax base is going to result into your taxable? Okay, okay, yeah, okay. See, this is all logic. I will ask you only one question, simple question. Income tax raid happens. Okay, when they say income tax raid happen, they say that in the name of one owner, one house property is there. They first see that this house belongs to whom? That owner says it belongs to me only. Have you showed me in the balance sheet? Have you shown me for income tax return? No, because if they had already shown for the income tax return in their balance sheet, if the house property was shown, then they would not have asked, no, this house belongs to whom? While doing search, they found one asset. They asked whom this asset belongs to. They say, sir, this asset belongs to me. But immediately they say, you didn't disclose it till now. So now in this case, what happens? Book value or carrying amount is greater than tax base, because tax base is 0. For income tax, they don't know only that such a house asset exists in the name of one guy. Book value, say for example 100. Now tell me, will income tax department raise demand for tax or will they refund the tax? Simple, no? That's why it is your taxable. Now, if you want, I will give you ask me, I will give you an explanation with the examples, like whatever way you want. Oh, sir, P&L effect is there, depreciation I claimed more, income, fines and penalties I added. You ask me, I will explain in that language. But not much relevant, no. For me, only one thing I have to remember, that if my book value is greater than the tax base, whatever reason, I have got some undisclosed income there, which are not told to the income tax department, or I have claimed deductions little more in the income tax by some hook or crook. Today's day, I have claimed more deduction. That's why my book value is more than the tax base. No. So income tax will always say you have to pay. So I have given an asset, you have got asset of 10 crore. So the income tax will always ask for demand. No. That's why when for an asset, you have to remember only one rule. Huh? Other rules you can derive from this rule. For when an asset carrying amount is greater than the tax base, that is the taxable difference. For a liability carrying amount is greater than the tax base, is the deductible difference. For an asset, when the carrying amount is less than tax base, deductible. for an asset, for a liability, carrying amount is less than tax base, taxable. Yes. Now identify the exception. There are 3 exceptions. One of the exception, they say that on goodwill is your asset. Yes. Don't recognize deferred tax. Why? See, what is the deferred tax? What is the goodwill book value? Say for example, book value of the goodwill is 100. Will income tax recognize this? No. So what is the deferred tax on this? But tax base? Sorry? This is a permanent difference. 1 minute. Huh? Will they not give you deduction, Baba? Will they not give you? When you claim impairment of the goodwill, will they give you? Will they give you in the future when you claim impairment of the goodwill? They will give you. No, impairment of the goodwill is a deductible expense. No, or whatever. Now you don't bother now what exactly they are going to give you or not. Look into the question. In the question they say that it is only claimed as an impairment, they will give you deduction. Today's day goodwill they don't recognize. It is deductible. When you remove this goodwill out of the balance sheet, no, it is tax deductible. You will get a benefit. But if you start recognizing on this difference a deferred tax, no, problem with what happened, no, your goodwill is again going to increase. See, first of all, you recognized one goodwill today in the books. Did income tax recognize it? No. Is it a permanent? No, because tomorrow when you claim deduction, no, they will allow you deduction. It's called impairment of the goodwill. Impairment of the goodwill is an expense. Your accounting entry is expense account debit to goodwill. They will give you the deduction. So you have got a difference now. So your book value is greater than the tax base. Now you say, sir, I have got a deferred tax liability. But the standard says don't do this. Why? Because if you recognize deferred tax liability, then first of all, goodwill is a balancing figure. In your consolidation you have done, no, previously, how do you calculate goodwill? Goodwill is the accounting difference between purchase consideration what you paid and the net assets what you got. So if you recognize deferred tax on this, deferred tax liability is going to come. Goodwill is going to change. Again on that, again deferred tax liability is going to come. Goodwill is going to change. It's called a circular effect. Like somebody is telling, I didn't have a job. Why? No experience. Why don't you have experience? I don't have a job. Circular, it will go on. That's the answer. Followed, no? So like, thus the tax base of the goodwill will be equal to the book value. You have to say some way of looking at it. Okay, somebody say it's a permanent. On initial recognition of an asset or liability that does not have effect accounting or a tax profits. For example, entity X imported a special machinery of 100 rupees. Tax laws don't permit any depreciation and profit on tax is also not taxable. That means tomorrow you don't have any implications of tax. Tax base is nil, but this is a permanent difference. So that's why in the primarily they say on permanent differences don't do it. Anyhow, no, don't much application, students. We will move on to the questions now because our major problem is done, tax based discussion. This is all theoretical. And the third is temporary difference with the investment in subsidiaries. Like you have got undistributed profits. If you can control the dividend policies, there is a temporary difference, but you don't recognize dividend, what is it called, deferred tax liability, if you can control the dividend decision policy. Because we discussed on investment in associate. There was one temporary difference, no? Because 100 rupees was the base value. You add share of profit 10, but they didn't recognize you. So you said 110 and 100 rupees. You say now I will recognize deferred tax, asset or liability. Deferred tax liability. Why? Because carrying amount is greater than the tax base. But the standard says, look, you can create deferred tax liability only if you can't control. Because if you can control this liability also, no. That means it's not your liability. You will not distribute the dividend or you will distribute the dividend right now. So there are 3 exceptions to it. The exception says that, first exception says on goodwill you don't recognize. Second exception says that on permanent differences you don't recognize. And the third exception, if you can control the dividend policy of the subsidiary, don't recognize the deferred tax. Yes, that rest is simple, students. asset recognition on the deferred tax asset. Now, what say the standard says on the deferred tax asset? You assess the recognition. That means if the carrying amount of the asset is less than the tax base, you will say it is a deductible. But the standard says before you claim, you have to check three conditions. Do you have deductible difference, tax loss, or tax credits? Then only you recognize. Deductible difference, existence of taxable difference whose reversal pattern match with those of deductible. Like today, you have got deductible difference 4,000. How it is going to get reversed? 1,000, 1,000, 1,000, 1,000. 4 years it is going to get reversed as per income tax, whatever pattern. Today you have got taxable difference, but it will going to get reversed 3,000, 3,000, 3,000. Are you clear about this? You're clear, students? See, today's day I have got a taxable difference. Why taxable? CA was greater than TB. And for some item, CA was less than TB, I got deductible. How it is going to get reversed in the future? It is going to get reversed 3,000, 3,000, 3,000, 1,000, 1,000, 1,000. If you observe, I don't have anything in the year 4 to claim this as a set off. Then the standard says, look, it is like you create one asset for yourself by claiming as an income. On a conservative basis, do one thing. Defer tax liability on full 9,000 rupees because this is the tax you have to pay. Tomorrow you have to pay. But today when you recognize deferred tax asset, don't recognize on full 4,000 temporary difference, but you recognize only on 3,000. Why? Because 4th year, you don't have any taxable difference there to adjust. Then you say, sir, what about if I make a profit? That's fine. Check the probability of the future profit. If you don't have this, do you think that 4th year will you make any profits? Then you can claim this deduction. Otherwise, if you make loss and that you have got some deductions, what is the benefit of that? So, for example, you got my point. See, you add back. Add back is always taxable. Followed, no? Expenses claimed, you have to pay. So, add back will result into a tax liability. You claim a deduction when it makes sense. Only when there is a profit, no. First of all, you made a loss and you claim more deduction. Your accumulated loss is going to increase now. So, that asset is useless for me. That's why first you check on the last year, do you have temporary difference? If yes, recognize full 4. No, recognize only 3,000. Are you clear, students here? Yes, Vindhya? Are you clear here? The itself basis, like suppose income tax, depreciation on what is that called? Your asset. Your life is 3 years, so you will claim 3,000, 3,000, 3,000. As per income tax, you can claim only 25% depreciation. 1,000, like this. That's the reversal pattern. Yeah, it's a very nice question. I understand, because if you understand that, you are trying to understand in things in totality. Otherwise, today we are talking only about today's year. You have to think about future year also. If 4th year, if you don't have this, question comes, do you have profits? Say for example, I don't have this. I have got only profit of 500 in the year 4. Then how much deferred tax today I can recognize? Question is clear? My question goes like this. See, today you have got a taxable difference of 9,000, deductible difference of 4,000. On 9,000, there is no assessment. Straight away 30% you recognize a liability. What entry you pass? Expense to liability. Now, on 3,000 also, will you take 30%? 4,000? Will you say asset account debit to income? No, standard says, look, 3 conditions you need to check. First, see, this 4,000 is something which is going to get reversed in the future. It's a temporary difference, no? Will it, when it gets reversed, do you have sufficient taxable deductible deductions also to match it? If answer is yes, for all the 4 years, you claim on 4,000 into 30%. But do you have it? No, last year I don't have it. Then you say, sir, I have to do only 3,000 into 30% now on a conservative basis. No, sir, last 4th year, I don't have a taxable deduction, but I have got a profit of 500 rupees. Then then you say, I will make a recognized asset 3,500. So, but another 500 I have got some tax planning opportunities which is coming in the fourth year. So, three things you need to check: whether do you have got a taxable differences which is going to match with the reversing pattern, do you have got a future profits, or do you have got the two future tax planning opportunities, like electing to have interest income taxed on the receivable basis. Today you are paying on cash basis. Receivable basis, if you shift, what happens? No, the moment you make a provision, you pay the tax, then you can claim the deduction. Or deferring the expense deduction from the taxable profit, whatever you want to claim, you defer it. Or selling asset that generates non-taxable income and purchasing other investments. So, if by doing all these things, if you can claim the deduction, because you have got what is the life of one deduction, loss is there, how much years you can carry forward? 8 years. So, can you plan your taxes in such a way that by the 8th year you actually claim the benefits? You can do now something, you can plan for it, like selling some assets, incurring short-term gain, setting off. That's called a tax planning. If you can do that, you can claim it. Okay, what about the tax losses? That is which you can carry forward for 8 years. Tax losses are going to create a deferred tax asset for you. Why? Because book value of the tax loss is 0. Tax base is whatever amount of loss. So, since your tax base is greater than 0, your losses are going to create an asset for you in the future. So, first you apply all the 3 criteria and you have to make sufficient disclosures. That means deferred tax you can recognize only if it is so and so. We can have a future profits and all. The last is tax credits like TDS or tax MAT, minimum alternative tax. Yes, you can create deferred tax asset on the MAT, minimum alternative tax. Have you worked on this? Only if 3 criteria are fulfilled. Again, no need to much go deeper here. It says that whether it is a tax loss, whether it is a taxable deductible difference, or whether it is a tax credit, you can recognize deferred tax asset, because all the 3 will result into deferred tax asset only if the 3 conditions fulfill. If no, don't create. Like for MAT, what happened now? Whenever you play that minimum alternative tax, your accounting entry is MAT expense account debit to bank, and the amount of MAT you paid, no, it is your deferred tax asset to deferred tax income for your academic interest, right? Not relevant much. Yes, the next is the determination of the tax rate. When I say into 30%, is it 30 or 35%? Is it this year rate or the next year rate? The standard says that the deferred tax should be measured at the tax rate which is enacted substantially by the end of the reporting period, by 31st March. Is it something enacted? If answer is yes, that's why when the tax rates you will come to know. By February only you will come to know. That means by 31st March you know exactly what tax rates are applicable for the next assessment years. So you have to take that. So, and you may have to apply different rates for different purpose. Like an asset can be hold for collection or hold to sale. If hold for collection, normal business profits are applicable. If held for sale, capital gain taxes are applicable. So you have to think what is your intention of holding and apply respective taxes. Deferred taxes are not discounted. So the last is the calculate the tax, which is when again a 4th or 5th standard student can do this. Taxable difference, multiply with the tax rate, you get the deferred tax liability. Deductible difference into multiple tax rate, deferred tax asset, we have to set off. And last is the accounting, which is again very simple. It says that the accounting of the deferred tax effect of a transaction shall be consistent with the accounting of the transaction itself. What is the meaning of this? That means if you have taken any transaction to the P&L account, like depreciation, you have created deferred tax on the depreciation. Where you should show the deferred tax? In the P&L only. If you have created deferred tax on revaluation, where the revaluation will go? OCI. Now, have you seen in Schedule 3 format, what is the heading? Items recyclable, 3 or 4 items. Below that, plus deferred tax effect on the above items. Have you observed it? Then items which are not subject to recycling, second category. You have got some items there. Then one more heading comes, deferred tax effect on the above item. That means if the item is outside P&L, say for example OCI, the deferred tax effect of this item should go to OCI only. Don't bring it into P&L. And something which you go into the other equity, straight away in the balance sheet only, take it to the balance sheet only. So deferred tax always comes on the balance sheet item. Now that balance sheet effect will go into the P&L, take to the P&L, OCI, take to OCI, or take to the balance sheet. The last is offsetting. You can offset deferred tax and asset and liability if we have got legally enforceable right. That means deferred tax of India, you don't offset with the deferred tax of UK, liability of a UK. You should have a legal enforceable and you should be the same taxation authority. Yes, with this, I know too much of theory. First part we are done. So now two more aspects are left called the tax reconciliation and ESOP. Before that, we will solve some problems. Yes, so we will move on to the first question. Do one thing, okay? In the first question, you add, write solution 1, you add two things, book value, tax base, because you only have to tell me now. We have done this, already we have done, so that I can just show you the answers. Now, this is an examples, okay? So many examples they are given. I'll start with some basic examples. What they asked me, determine the carrying amount, which is nothing but the book value, and the tax base for the below items. Tell me the first one. Machinery acquired 1 lakh, depreciation on SLM 10%, taxation loss gives you 30% deduction. What is my book value? Okay, if you want, you can note, and tax base 70,000. Very good, perfect, done. That's all. If you want, you can note down, otherwise you can just discuss with me, because it's just an example to warm up exercise. Next, inventory is carrying amount of 1 lakh at the reporting date. It recovers its value through sales in the subsequent period. The sale value is the economic benefit derived by the entity and it is taxable. Oh, that means when you sell in the future, that becomes a taxable. However, as per the matching and other concepts against this sale, entity is entitled to deduct its cost. The cost is the carrying amount of the inventory, 1 lakh. 1 lakh is my book value. What is your tax base? English language they will use. Till now we were talking in a layman language. My objective to show you is the languages here. So what you do this time, okay, what accounting entry you pass for the inventory? Inventory account debit to? Yeah, I don't expect at this point of time. If I had have done Ind AS 2, definitely I was expecting, please tell me the journal entry for inventory. What is my accounting entry for inventory? Okay, that is one entry. But at the end of the year, how does inventory comes? Okay, purchase to, let me talk about this entry. Your first accounting entry is purchase to creditors. Then, did you consume this? No. Now, what accounting entry you pass? It was there with you or no inventory, no? So you will recognize at cost only. What accounting entry you are going to pass for the recognition of inventory at the end of the year? How do you recognize? First, you count the inventory. You say whatever 100 chairs you purchase, 100 is there with you, and the cost of 100 chairs is 100 rupees. What accounting entry do you pass? Closing stock account debit to purchase. Or I can say purchase is COGS. You pass the accounting entry, closing stock account debit to COGS. That is not your COGS no, anymore. That much you don't recognize. How much? 100. This you take it to the balance sheet, and this you credit it below sales. In our primary school, we have learned, no? Below sales one inventory, that is this. purchase COGS, not that inventory. We say buy closing stock, but actually it is a buy COGS actually. Followed, no? Now tell me, students, you have offered this for income tax. Okay, this is the entry you passed. Did they give you deduction for this? Did they say, no, income tax, inventory I am not going to recognize now. Okay, inventory you pay me taxes in the future only. Have they told you like this? Will you get any deduction for inventory? No. So what is the tax base? Same. So if I go back, my tax base is also same here. That's why simply language they have used. Because you recognized one inventory. By default, that inventory also came here only. When this is deductible, next year it is deductible. If you don't sell that next year also, it will come as a next year closing stock. Like this, it will go on unless you sell it. And the day you sell it, you offer in the, you de-recognize from the balance sheet also, books also. You claim deduction in P and taxation also. That's why I can say this like more like a permanent difference. Means your treatment of inventory in your books as well as in your accounting is one and the same. Difference will come when you treat it different way here, you treat it different way there. When it comes to inventory, is it like that? Reserve for bad debts, you say yes. Taxes and penalty, you say yes. Interest on income, interest income, you say yes. Because today here in the accrual basis, there it is the cash basis. ROE said accounting, yes. But my inventory same, no. How do you treat here or versus you treat in asset? So my asset and the carrying amount is same. Are you clear? An item of asset has got 1 lakh rupees for certain acquired an item. Okay, this is a PP. It is deductible equally over the 2 years. Income tax 75,000 deductible in the first year and balance in second year. So at the end of first year, how much is my book value tax base? 50,000 and clear? Interest receivable has got a carrying amount of 100. Revenue will be taxed on the cash basis. Yes, tell me. What is my book value? 100. Tax base? What is my tax base? Why? It's cash base, temporary difference. Followed, no? 100 and 0. Like this, no, simple. Trade receivable. Entity follows the mercantile system. You have got a trade receivable of 1,000. You made a bad debt provision for 50. The book value comes to 950. Income tax says that, look, bad debt provision I don't deduct. You pay me only when you claim the actual bad debts. 950 and 1,000. That's what I told, no? Like fire. Look at it, you understand it. Don't need to have any income tax knowledge here. An entity follows the mercantile system, a trade receivable of 1,000 and claimed a bad debt provision for it and book value is 950. But income tax specific bad debt deductible, in the very first year it is created only.
950 and 0.
Don't jump. Huh? Oh, fire, nothing happens. You don't put your hand into the fire there. My mind will tell me immediately. Read the question now. This is 50 is a special bad debt provision, which income tax also gives me the deduction. 950? 950. Yeah, it's like in inventory. Your treatment in income tax and treatment in accounts is one and the same. No. It's only when there are two different, then only you get the tax base and this difference. No. And in fact, when it is different, but it is never taxable, then permanent difference. An investment is made in the equity shares 1 lakh. There is no tax gains that arise on the sale of listed equity shares. You invested 1 lakh. And tomorrow, whatever profits you make, it is not taxable only. What is the tax base of this? 1 lakh. Book value is 1 lakh. What is tax base? 1 lakh, because this is no future tax implication. It's like a permanent difference. Or you say that, look, the day you bring investment, that base value is remaining there also. No. The differences comes where? Is there any difference in the recognition of principal amount? No. The differences come, you recognize FETPL, they don't recognize FETPL. Loan given, entity has given a loan of 10,000 rupees. The repayment of has got no tax consequence. Same, 10,000, 10,000. See, there are different ways to understand this, but my question is, do you need it? What is your priority? Examination, no. You have understood the logic, fine. In the examination, in the interview, they may ask you. Then you explain with taking anything, like you can tell this, sir, this, that, a permanent difference, finish, matter close. Or you say, sir, this has got no tax consequence. Or you say, in this way, sir, this 10,000 is my principal amount, I pass the entry. The same entry I will pass in the income tax also. That's why 10,000, 10,000. Explanation you can give in a different ways. During the year, they capitalize the development cost as per paragraph 57 of Index 38. Oh, the total amount is 100. The development expenditure is fully deductible by the end of the year only. But no deduction was claimed for books. 100. Yes, Vishnupriya. Suha is claiming it is 0. What is the it's in the profit and loss. They have claimed as a full deduction only. Income tax says, Baba, take full to P&L. No balance sheet. But in my books, I have taken it to the balance sheet. I have not claimed as an expense. So it is 100 and 0. Yes, done. So I hope you are noting from time to time. It's an example. Just I said no, warm-up exercise. So 100 and 0. Now let us go to some examples of liability. If you see this particular chapter in the study material, so many examples they have given. Now, accrued expense. Current liabilities include accrued expense of 100, but they will pay on cash basis. You can claim it as a deduction only on cash basis. 100 and yes, because you claimed expense to liability, but they said no, I will permit you on cash basis. Current liabilities include accrued expenses with the carrying amount of 100. Related expenses already deducted for tax purpose. They say full amount is deducted. Deducted. Your book value is 100. What is the accounting entry you passed? Expense account debit to liability. Did they permit deduction? But what is the difference between you and them then? Did they add back this expense? No. That means in their books also, how much is the liability? 100. Tomorrow when you pay, will you get any second deduction there? No. That what they are trying to tell here and here. See, here it is 100, 100. In the first case, you passed the entry expense account debit to liability, which they added it back. That's why they didn't recognize this liability. In the second year, you passed the entry expense to liability, they permitted it as a deduction. Since they permitted it as a deduction, they continue to recognize this as a liability in their balance sheet. No. Yes, Vidya. Dhanashree, you are not clear. What? See, first case, I claimed expenses, but they didn't permit that expenses. That means that expenses they didn't recognize. So in my liability, which is sitting in the balance sheet, book value is 100, tax base becomes 0. But in the second case, they deducted in the deduction the day I created a provision. That means they accepted my liability. No. That means my book value is 100, and since they accepted it, tax base is also 100. Or if you want, you can tell, sir, it is a permanent. There's no difference, no. Between you, what you did in books versus what you did in tax, there's no difference. Difference comes only if they add back. Followed, no? And that whatever you added back will they provide in the future. Again, we call it balance sheet approach, but it is another way of P&L approach only. In P&L also, whatever you add back, if it is deductible in the future, you say deferred tax. Added back, but not deductible in the future, permanent difference. This is what you used to tell. I remember in my childhood, no? Second year, or not second year, in the intermediate, I was studying. This type of logic was applicable. But today I don't go with that. We go with the balance sheet approach. We say deductible not payable. Current liabilities includes fines and penalty, 100 rupees. This is not deductible for tax purpose. 100. Very good. What you said? 100. Permanent difference. Loan payable carrying amount of 100. And when you repay this loan, it has got no tax consequence. 100. Perfect, no? Students? Interest received in advance. Current liabilities includes interest received in advance, bank to interest received in advance. Carrying amount is 100. And when you tax on cash basis? 100. I received. So bank account debit to interest in advance. This is your liability. Now what is the book value? 100. But when income tax will recognize this, did they recognize this entry? On cash basis. Today only I will recognize it. I will take it. I didn't take it to the balance sheet. I will take it to the P&L account. Followed, no? So what I am going to do with this? Okay. So, okay, let me explain again. I got disturbed. I have got the interest revenue, bank account debit to interest in advance. When I claim 100. But the income tax said, see, since you received this money, right now pay tax. I paid it. So my tax base is 0 because they never recognize. This is similar to that customer advance I received, no? Income tax said, look, whatever you received, bank, this is not your liability, this is your income. But I'm saying, no, sir, this is my liability. I am not given at service now. You say, see, look, you give service in the future, I don't know. But for me, since you received it, you have to pay tax on it. That's why what item I am telling, oh, it's my advance from the customer. Income tax says it is not your advance from the customer, it is your income from the customer. Then income tax says, look, do one thing. Today, you didn't show any item in the P&L, no? Did you show anything in the P&L? No. Why? Because everything you showed as an advance. The day you render the service in the future, will you show in the P&L? Then I will give you deduction. Then you need not pay tax. Then this becomes a temporary. Followed, no? That's why it is 100 and 0. Yes, so what is the doubt? Clear, no? Provision for closure cost. EA committed to the closing, making number of employees redundant. Therefore, they recognize the provision for closure cost of 200. Income tax will deduct only when you are actually paying it. 200 and 0. Because you will permit it only in future, no? They didn't recognize this entry from you. Okay, last two. I think we have done this. Borrowing cost 100 rupees. My transaction cost is 2 rupees. And I need to pay 130 rupees. We have done now an example. Interest, effective interest rate is 10%. Income tax says that this 30 rupees I will permit only in the future. So you have to calculate the book value. What is my book value? 100 rupees minus 2 transaction cost into 110%, 1.10. Gives you 107.80. But for tax, it is 100. And the last one, gratuity. Entity makes a provision for gratuity, expense account debit to gratuity. But the tax says that I will permit this gratuity only when you pay in the future. So your provision is 100, but the tax base is 0. Yes, so this is all about the liability. Yeah, one more small expense we will do, then one small example, then we can take a break. Now, determine the carrying amount of the tax base. Incorporation expenses, preliminary expenses, incurred 1 lakh on its incorporation, charged to the revenue very first year of accounting. That means preliminary expense is 0 as per balance sheet. But as per tax laws, they will permit 5-year deduction. 80,000. Very good. Entity incurred public issue expenses of 100, written off in the very first year, deduction of permit 80. Yes. So take out question number 4. This is a small question. An asset which is cost 150 has got a carrying amount of 100. They only told you. And the cumulative depreciation for tax purpose is 90 and tax rate is 25. So what is my tax base? So write solution. Tax base is equal to, what is your tax base? 150 minus 90. How much? 60. Do you have got a deferred tax asset or deferred tax liability? See, 150 is your cost, 90 is the tax depreciation. So you have got a deferred tax liability here, right? Deferred tax liability. How much? Your book value is 100 minus tax base is 60. Correct? Book value is 100, no? Tax base is 60. This will give you temporary difference. Since the book value is more than the tax base, into 25% gives you 10 rupees as the deferred tax liability. See, tax base is cost minus depreciation of the income tax, 90. You got 60 rupees as the tax base, correct? Are you clear, Prithvi? Second, what is your deferred tax liability? 100 is the book value minus tax base is 60. Since carrying amount is greater than the tax base, you have got a deferred tax liability into 25% gives you 10. So I have got in this format, I will change it. Okay, we will do it in this, whatever going forward. Yes. Yes, so we'll move on to the example. Okay, so there is a difference between this and test your knowledge question, I will tell you. An entity acquires an asset first day of the reporting period, which is 120. On 120 rupees you purchased cost. You can note down this number. Life is 6 years. So 20 rupees depreciation you are going to claim. No residual value. It depreciates on the SLM basis and the tax rate is 30%. The depreciation, tax depreciation for each year, the tax depreciation for each year of life, 90, 10, 7, 5, 5, 3 respectively. So they only gave you the tax depreciation. Tax means how much is permitted in income tax. This is tax rate. How much depreciation is given against this 120? Okay, did they give you full? In the first year they give you full 75%, I think, correct, no? 90 divided by 12. 75% deduction they give in the first year. And then they give some different percentage. So eventually over a period you claimed 120. Now calculate the book value as per financial. Very easy job. And tax purposes, that is also very easy job. And then deferred tax liability. Okay, so first thing we'll write solution. Financial statement. Financial statement. So we have got 6 years, no? 1, 2, 3, 4, 5, 6. Yeah, you can just note down. Yeah, it is not there. That's what I told. So what is your gross block? 120. Is it going to change? 120. How much is depreciation? 20. So next year cumulatively it becomes 40, 60, 80, 100, 120. Because accumulated depreciation, no? It's not depreciation, because we are talking only about the balance sheet now, Baba. At the end of the first year, the book value or carrying amount is how much? 100. Second year it becomes 80. Third year it becomes 60, 40, 20. You may wonder what this question is all about. Yeah, but this question they may ask you in the examination. Because when they ask you in the examination, I'll show you what they may ask. So in the step 1, we calculated the book value. This is what they asked me. If I go back to the question, they asked you, calculate the book value. This is my book value at the end of every year. Are you clear? Yes, Prithvi? Yes, question you want to see? This is 6 years in income tax, where first year I claimed how much? Only 1 by 6. But here for tax I claimed 75%. And on what basis 10, 7, 5 and all, leave it. I am telling you, no, right now, don't think what income tax is telling me. Look into what they have told you in the question. Now, how much is similarly I have to prepare for taxation also. So tax computations or tax balance sheet. I have got 6 years. 3, 4, 5, 6. What is my tax base for the first year? 120. How much is depreciation you claim? 90. 75% depreciation. So book value or tax base? They don't go with the concept of gross block, accumulated depreciation and all. They don't have that concept. Followed, no? Next, how much is the opening balance? 30. How much is the tax depreciation tax claim? 10. As per income tax, how much you claim? 10 rupees. So you got 20. Opening tax base become 20. 7. You have got 13. Like this, you will go on and you will calculate the tax basis, which is going to become 0 at one point of time. Yes, students, you can pause the video and compute this, calculate this. So you see that there is a temporary difference between the book value and the carrying amount. So you have to write next movement in temporary difference. So for the next 6 years, what is your movement? See, they may give you with a big amount in the exam. Small question, but they know how to kill your time. So be careful. So what is your book value? 100. Then second year, 80. Third year, 60, 40, 20, 0. What is your tax base? 30, 20, 13, 8, 3, 0. You understood? Now you see very clearly. Balance sheet at the end of the year, what is your book value? Which is nothing but gross block minus accumulated depreciation. End of year, what is your tax base? This is my tax base after tax depreciation. Now, do you have got a temporary difference? Yes. How much? 70, 80 minus 20, 60, 47, 32, 17, 0. Now, is this taxable temporary difference or deductible temporary? Why? Book value is more than the tax base. So, and okay, but did they ask me deferred tax or movement in temporary difference? Movement in temporary, they didn't ask you. Understand there is a difference. Movement in deferred tax, movement in temporary difference. Look into the question what exactly they are going to ask. So, what is my cumulative impact? First there was 70. Second year, 70 has reduced to 60. So, minus 10 in this 70. Are you clear? That means the reversal happened of this temporary difference. Third year, minus 13, minus 15, minus 15, minus 17. So, the first year's temporary difference is there, no, 70. It got reversed subsequently into minus 70, cumulatively. Are you clear? You remember that 9,000 and 4,000 example I was telling you? It's something like this. It is going to get reversed subsequently because of the different rates of depreciation. So this is my movement in difference. Yes, friends. You can pause the video to calculate to compute this. Yes. Okay. Are you clear, students? See, now in the study material, this is an example. In example, they didn't tell you. Actually, it is my question. I asked you calculate the movement and all. Study example, they don't tell you. But example, they will ask you in the examination. Are you clear? Next thing, we will calculate the movement in the balance sheet. Now the deferred tax is going to come. Temporary difference is not a movement in the balance sheet there. What is the original movement in the balance sheet? Your tax book value. So write last one, movement in balance sheet. You got 6 years. So understood, no, students? One is we calculated the book value first with the gross block and accumulated depreciation. Second, we calculated the tax base. There is no concept of gross block. It's like a WDV concept. The third, we found out how much is the movement in the temporary difference. That means one temporary difference today, a 70 big difference, is going to get reversed. So, how much this movement is going to happen, in the bracket you can write deferred tax movement. So, how much is your temporary difference? 70, 60, 47, 32, 17, 0. DTL at 25%, no? The question is talking about 30%. How much deferred tax liability is going to come? 21, 18, 14, 10, 5, 0. That means as at the end of the first year, the total liability, deferred tax liability should be 21. Is there any opening balance? No. So your movement in provision is 21. That means today you are going to pass one accounting entry, deferred tax expense account debit to deferred tax liability 21. Are you clear? See, 70 is your temporary difference. At the end of the first year, the liability should have been 21, 30% of this, 21 rupees. But you never created it. This is the first time it's coming. So you pass an accounting entry, expense account debit or deferred tax expense account debit to liability. Next year, at the end of the year, how much should have been your balance of the liability? 18. But how much it is sitting already? So what you should do? Reverse that liability. What accounting entry? Deferred tax expense account debit to deferred tax liability account debit to deferred tax expense or income, whatever you call. How much? Minus 3. So this is movement is going to hit your P&L. This is what is appearing in the balance sheet. So difference between your opening liability and the closing liability, if the closing liability is going to increase, that much expense you are going to claim, expense. If it is decreased, you will charge it as an income. It's called a reversal. Third year, minus 4, minus 4, minus 5, minus 5. So today, on day 1, you recognize plus 21 as a deferred tax liability, which is going to cumulatively get reversed in the subsequent years. Are you clear, students? First year entry will be deferred tax expense account debit, which is part of you have got profit before tax, no? Less tax you do. One is current tax, which is cash basis, plus deferred tax. And next year onwards, minus deferred tax. Why? Because these 21s, one portion got reversed because of the temporary difference. It is very difficult to pinpoint and figure out one by one. That's why we prepare something called a tax reconciliation later. So you don't go. See, have you in principle understood how it operates? Enough. So going forward, every problem you need not go much deeper. Just understand the procedures. Because every problem, if you go back, no, it's going to consume time for you. Yes. So move on to the next question. Question number 6. Company purchased an asset for 1 lakh. 5 years life. Depreciation will be 20%. And the depreciation for tax will be 25%. Operating profit and the tax, have they told you WD or SLM? Taxation? SLM. That's what you don't think now what in reality happens. Leave it. Question is very silent. You can assume it to be SLM. In the examination, they will tell you what exactly they want to do. Operating profit is 1 lakh for all the 5 years. Tax rate is 30% for next 5 years. Calculate the book value as per financial and tax purpose and then deferred tax liability. So what you need to do here is you have to calculate the book value. You have to calculate the tax base. And then you have to do the last one, not the movement in the temporary difference. See, in the previous step, there were 4 workings. Book value working, tax base working, movement in temporary difference and the balance sheet working, balance sheet movement. In this question, you have to do only the first 2 and the last one. That movement in temporary difference is not required. Are you clear? Yes, students. So please pause the video and do this. Let us compare the answers. Yes, students. So we'll compare the answers. See, first year is the book value. Gross block is 100 only. Accumulated depreciation is going to increase and your book value becomes 80, 60, 40, 20. And the last year it becomes 0. Clear? Then they asked you the tax base, which is 100, 75, 50, 25. The tax base is 75, 50, 25, and the fourth year only it becomes 0. Now, if you see the solution of the study material, they have told gross block and accumulated depreciation. See, in the example, they have done in one format. In the study material, textual knowledge, they have done in another format. No, we'll keep the same thing, what they have done in the example. Are you clear? Now, the third is the difference between the book value and the tax base is 5, 10, 15, 20. On 5, deferred tax liability, because my book value is greater than the tax base, 1.5 is going to come. First time I'll pass an entry expense to liability. Now this liability is going to increase. And the last year, the liability is going to get reversed. Because this is my, see, at the end of the first year, the liability should have been 3. I'll recognize additional 1.5. Additional 1.5. And the last year, there is, it will fully reverse. So I will reverse that. Are you clear? Yeah, movement in temporary difference they have not asked. So one of the questions they may ask you. Now, A Limited is incorporated recently. It incurred 1 lakh incorporation expenses. They charged in the year of revenue only. Taxation loss allows in 5 years. Tax rate is 30%. What is my deferred tax? Do I have a deferred tax asset or liability? Okay, for this, right, deferred tax is equal to, what is my book value? 0. Minus, what is your tax base? 80,000. See, it's like preliminary expenses. We discussed one example now. Book value is 0 because you claimed it as an expense. Into 80,000 because income tax says I will give you deduction in 5 years. Into 30% is equal to 24,000. So your accounting entry will be deferred tax asset account debit to deferred tax income. This is, you can say, DTA. Why? Because my asset is an asset, no? Preliminary expense is an asset, no? Yes. Why? Because if you would have capitalized it, it would have become one fictitious asset for you. Preliminary expenses. Book value is less than tax base. So deferred tax asset for an asset. That's what I have given in this format, but I realize now that once I've understood this format and all waste of time there, if you open the study material, you see that they have done straight away there, just like ESOP thing. Otherwise, if you want, you can maintain this format: book value, tax base, temporary difference, find out and multiply with the 30%. Or you can just explain in one simple single line notes. The income tax provision provides that if the price of the land is sold after 1 year, you get the indexation benefit of 10%. Thus, if the land is sold after 1 year for 1,50,000, so this they have removed it, okay, from the study material. Previously, this was there. They have removed it now. Oh no, sir, now they have added, not removed. Previously, this question was not there with any numbers. So they said that after you have sold the land for 1,50,000, the cost of the land will be for the taxation 1,10,000, like 1 lakh rupees invested now plus 10%. Previously, they didn't tell you the sale price. If it is sold after 2 years, the land for the taxation purpose will be 1,21,000. That means 1,10,000 into 10%. Taxation rate is 30%. Calculate current and deferred taxes. So note, there are controversial views on the indexation of land. This is not my note, this is ICA note. For a temporary difference, because if the land is not going to be sold in the near future, particularly in business, then it is not advisable to calculate the temporary difference. Why? Okay, first of all, tell me, do you have got a deferred tax liability or deferred tax asset? For this, I need a book value. What is my book value? Huh? What is my book value? You have got a land. Yes, Prithvi? Huh? Book value. What is my book value? Simple. See, again, there is nothing. We'll go every single problem. You need only 2 components. What is your book value? What is your tax base? That's it. Okay, my only question to you is, did you purchase the land? Yes, obviously. No? Then only you will be able to show. Now, my question to you, if you have purchased a land, at the end of the first year, what is your book value? Just read the question and tell me. Don't this. Or right now, whatever it is. You make an assumption. Okay, if you say revaluation model, have they told you revaluation price there? That is indexation. Huh? That is a different story. That is not a revaluation. In income tax, when capital gains are going to come, there is an indexation benefit applicable to you know. So it is not a revaluation. And that is the income tax related adjustment. What is your book value? 1 lakh, exactly. Your book value is 1 lakh. Okay. So now I have to calculate deferred tax. I don't know whether it is a deferred tax asset or liability when I start with the deferred tax. I'll leave some space to write what it is, asset or liability. Book value is 1 lakh. What is my tax base? Now question comes, what is your intention when you plan to sell? Followed? No. So if you have to create one deferred tax, say let us assume that this land is purchased right now at the end of the year only. End of year. That is on 31st March only it is purchased. What is its book value today? 1 lakh. Now question comes, when you have planned to sell this? Have they told you? If you sell after 1 year, so and so. If you sell after 2 years, it is so and so. They have to given both the thing. No. What is when it's planned to be sold? Huh? See, again, that's what you should learn. First thing, when the question is very silent, take an assumption. If it is assumed that the management intends to sell it at the end of the first year, what is my tax base today? 1 lakh 10. If the management is planned to sell this at the end of second year, what is the tax base today? 1 lakh 21. Now, do you have got a temporary difference? Yes. Because when you sell your book accounting, whatever, it is 1 lakh only, but you get some benefits there, extra deduction in the future. Now, this results into deferred tax asset or liability? Asset. Why? Book value of the asset is less than the, that's when now you say deferred tax asset. How much into 30%? 6,300. So if you tell, or if be careful in the question, this is an example, okay? Just this is an example. Some things we are discussing the example also. If at all they give you hint that they have planned to sell in the end of the second year, then you have to, no assumption, you have to take 1 lakh 21 only. Followed, no? So write deferred tax asset on land. Okay, before that, right, assumed the land is sold after 2 years. Otherwise, on what basis you say that it is 1 lakh 21 on today? You have to make an assumption. Why? Because in the solution they assumed like this. So deferred tax asset on land today will be 1 lakh is its book value minus 1 lakh 21 is its tax base. Because you have made an assumption that you are going to sell after 2 years into 30% gives you 6,300. Now, will you recognize it? Note, generally on land DTA is not recognized. Why? Because people don't have intention to sell. See, if you don't have any intention to sell only, even after 2 years, then why you have to create? And if at all you have to create, you take the maximum one. That's why we made this assumption. That is by default, it is applicable. The deferred tax will pass only after that condition. Here we are not talking about that condition. Otherwise, by default, any deferred tax asset will first pass through that condition. Second, land also we generally don't apply. So I have done it like this. We have given this note there, controversial view. So it is not advisable not to calculate the temporary difference. Liability we would have calculated. Yes, this is an example. Okay, don't bother much about examples. Focus on the some important questions. Like this, that is test your knowledge 4 question. They may ask you. Illustration number 6, they may ask you. Entity has got a deductible temporary difference of 50,000. Okay, understand. They only told you deductible difference. You need not calculate CA minus TB there. No, deductible means which is more now?
Book value.
Question is clear? If they say deductible is more, which is more? Tax base is more or book value is more? That's what you need to tell, sir. That depends upon whether it is an asset or liability. If it is an asset, it is like this. If it is liability, it is book value is greater than tax base. These two combinations will give me deductible temporary difference. Followed, no? Just because by looking at deductible, don't make an assumption, so my asset is less than my tax base. No. Because there can be another possible combination also. Are you clear, no? There are 4 combinations. I told you, remember only one because you can derive from there. And it has no taxable temporary difference against which it can offset. Okay. So you have got a deductible now. On which what you will do? On this deductible, what you will do? Deferred tax asset or liability? Asset. No, deductible is asset. Taxable is liability. So you have got only 2 types of deductions, temporary differences. Taxable temporary difference, deductible temporary difference. So it is a temporary difference which is deductible. That means deferred tax asset should come. Now, will you say into 30%? No, wait. You say, sir, wait. Whenever I say for a deductible temporary difference into I do, before that I'll pause for a while and just check 3 conditions, which we should have checked for the previous example also. Since it is an example, I just left it. Now, what are the 3 conditions? In the future years, which is going to, because when this is going to reverse, 50,000 is going to reverse, though in different pattern. We have seen that already in one of the questions. Do we have a temporary taxable temporary difference also in the same pattern? No, because first of all question says no taxable temporary differences to offset. Okay, no problem. There should be profits. Do you have any profit? Entity not anticipating any future profit. No profit also. However, what it can do, it can implement one tax planning strategy, which can generate profit up to 60,000 rupees. Oh, that means by my own plan, there is no profit. But if I develop a strategy of selling asset, investing, something like that, I can get a profit of 60,000 and the cost of this strategy is 12,000. So how much is my net profit? 48,000. Now, what is my deferred tax asset? Should I do 50,000 into 30%, or should I do 48 into 30%? 48 into 30. We have to limit it. Whatever deferred tax asset we calculate, we have to limit it to the extent either taxable temporary difference is available, or future profits are available, or tax planning benefits are available. Yes, tell me, what is your problem? Future profit, because if you get, that's what I told, no, like today you have got a taxable temporary difference and you say deferred tax asset is going to come to me. That means you claim less tax, telling that I will claim this tax in the future. To claim the tax in the future, first of all you should have a profit. No, every year loss only. Do you feel any benefit of TDR, like whatever tax benefits you are getting? Like you get some extra deductions. That extra deduction makes sense in the year you make a profit, no? And you, next 10 years, you will continue with the loss only. So you will never be happy with the accumulated loss, because it's going to lapse one day. Follow, no? So this is a bit theoretical, right? In the given case, you have to learn this also to write theory, because it's much theory. In the given case, deductible temporary difference is rupees 50,000. But entity has only rupees 48,000 tax planning opportunity. Therefore, deferred tax asset be recognized rupees 14,400 in the bracket 48,000 into 30%. That means to the extent of 48 only we should recognize, balance we need to ignore. Right now we will ignore. Next year, if I find that, because obviously this difference will come in the next year also, no? This deductible difference will be there in the next year. Next year, if I find that I can make a profits in the future, I will recognize next year. Otherwise, to this year, that 2,000 rupees, I will ignore it. Sorry? That is what, 2,000 rupees we didn't consider, no? That if you, next year, if you get a benefit, that additional, see, ultimately what accounting entry you pass? You pass an entry, asset account debit to income. Even though you don't pass also fine, no? Standard says fine. Why? If you pass, one day you will reverse this because you didn't have a profit in the future. So why you are passing? Liability is not like that. People will take the liability from you. Income is your. If you want, suppose if you have given a loan to someone, if you don't want, don't collect from them. Okay, that is your choice. But if you have taken a loan from somebody, do you have a choice? No, that's why deferred tax liability is like taking loan. People will come and catch our neck. Now, when I give loan to someone, I may catch, I may not catch. That's why they say that don't recognize the deferred tax asset. Are you clear, students? This question is clear, no? Yes. So we will move on to the next one. One example. Okay, not required, just for your understanding. Yeah, this example we discussed previously, no? You had got a PP. That PP is 9,000 and 4,000 we discussed, no? Life of 3 years, accelerated depreciation scheme, they claimed under full provision of 4,000, which is going to get reversed. We discussed, no, as an example. So book value was 9,000. Tax base was nil. So 9,000, 6,000, 3,000. Carrying amount of the liability of 4,000, 3,000, 2,000, 1,000. So you have got a difference of 5,000, 3,000, 1,000, 1,000. You remember that example. It will remain 3,000, 3,000, 3,000, 1,000, 1,000, 1,000. Reversal is going to happen. So you will say deferred tax liability of 1,500, 900, 300 minus 300. Okay, so this type of entries you are going to pass. And if you, fourth year, see when you said, I will consider this full 3,000, your assumption is one among the three is available. That means deferred tax liability is not available, but profit is available. If all the three are not available, then this you should restrict to 3,000 and on 6,000 rupees into 30%, 1,800 is the liability you should have recognized today. Okay, this entry is so fine. I told you, no, very easy entries. See, 1,800. If you think this is not available, you have to restrict it to 3,000 only. Yes, you can go through academically later. B Limited is a newly incorporated entity. Its first financial period ends on 31st March 2011. Okay, new company. Following are the temporary differences exist. They only told you taxable 9,000, deductible 4,000. It is expected B is going to make losses for next 5 years. Losses can be carried forward but not backward. That means once you exhaust, it is gone forever. Discuss the treatment of the deferred tax. Now, how to do it? That's what. But how to present? That is, see, this is we discussed in example. But when they ask you in the MTP or test your knowledge, they expect you to present in the examination. How do you talk about it? Hmm.
Deductible tax. Limited to 3,000.
Okay, but will you not present any workings? You understood? No. So now, see, till now I was talking an example, I was explaining you in the form of example and all. It's for our understanding. Now let us learn if this question, whatever we have understood, if they ask me in the examination and say discuss, discuss means you have to give more evidences. Discussion should happen on that. What I am going to do, what is this? I have to explain it. So how to do it? First write solution. Followed, no? I am teaching you now presentation. Huh? Year wise anticipated reversals. For going, before going to the discussion, you need to have something concrete in your hand, no working. Or will you get confused there by looking at the question? No, we are doing one working. So we have got when you incorporated, whenever this year, by first year is 31st March 11. So I have got 31st March 12, 31st March 13, and 31st March 14, because I have got one more, no, deferred tax asset is also there. Now, what is your reversal of? So you have got question, taxable temporary difference is 9,000. That means that difference between the whatever your book value of the asset and your tax base, which is more? Book value is more or tax base is more for an asset? If I have to get a taxable temporary difference, book value should have been more. I don't know what it is, whether book value is 1 crore 26 lakhs minus 1 crore 18 lakh, 26 lakhs 18,000, whatever it is. The difference is 9,000 here. So reversal, how it is going to happen? Reversal of accelerated depreciation. And how, why the difference came? Why your book value is more and tax base is less? Because of accelerated depreciation. What do you mean by accelerated depreciation? What do you mean by accelerated depreciation? Accelerator, when you press, what is going to happen? Speed increases. That means you are going to consume this fast. Where? You are going to consume that asset fast. Where? Books or tax? In the tax. How? Charging high depreciation. Since you follow accelerated depreciation, the tax base is low because you have charged high depreciation. You see the previous question, that 90 rupees, where you used to charge 20 rupees in the books, there you provided 90 rupees, 75%. Accelerated, that is called an accelerated depreciation. Because of you get one difference, which will get reversed equally, because in the question they said, have they told you anything there? Expected to reverse equally. That means 3,000, 3,000, 3,000. So accelerated depreciation is going to get reversed equally over next 3 years, which generally do not happen, not equally. Correct, no? In our first question, that 90 rupees was the big amount of depreciation, 20 was the book depreciation. Did it get reversed equally? No. 13 rupees, 10 rupees, 18 rupees, cumulatively 71 rupees. Okay, now what happens? Preliminary expenses. Now preliminary expenses, I have got a deductible. Why? Book value, what is my book value for a preliminary expense? 0. That's why tax base is higher. Since for an asset tax base was higher, you got a, this is taxable temporary difference, TTD, this is deductible temporary difference. How it is going to get reversed? They said this is also going to get reversed equally. 1,000, 1,000, 1,000, 1,000. Are you clear how to present this? And have you understood what we are trying to tell here? First, we are telling reversal of accelerated depreciation, because we charge high depreciation in the taxation, it is going to get reversed equally in the 3 years. And since the entire amount of preliminary expenses claimed in the books right now, which is going to claim in the equal, this is the reversal. So, Now question comes DTA recognition. Am I going to recognize DTA for the first year for this difference? Yes. Second? Yes. Third? Yes. Fourth? Wait. By telling this, which condition we are applying here? Which condition we are testing? We are testing the first condition, whether taxable temporary differences are available in the future for the reversal. As per that condition, no. Now second condition I will apply. Is profit available? No. Third, tax planning. Is tax planning anything they told? No. So you can say yes in star subject to tax planning. Question is silent, no. So you can tell that the last year differences, no, means today you can recognize, see, this you have got your 9,000, here you got 4,000. Since 1,000, 1,000, 1,000, you will get deduction all the years. Today's day, the last year is only the doubt. Then question is, should I do it on 4,000 into 30% or should I do 3,000 into 30%? I need to recognize the deferred tax asset now today. This is my total temporary taxable deductible difference. So I will take 3,000. Why? Or 4,000, whatever. This can be depend. You have to tell that, explain that. So if I have got a tax planning opportunity in the last year, then today I will recognize DTA 4,000 into 30%. If I don't have any tax planning opportunity, that means all the three conditions failed. So I will recognize on 3,000. Yes, now treatment of deferred tax. Write the heading, treatment of deferred tax. B Limited will recognize DTL. How much? Can you tell me, students, how much DTL I should recognize? Yes, Prithvi. Deferred tax liability I need to recognize. Dhanashri, how much? 2,700. How did you get this? On 9,000 rupees is the taxable temporary difference into 30%. Do you need to apply any condition to verify this? Not required. I need not verify any difference. Verify. Straight away 2,700 I have to recognize. However, DTA on deductible difference will be restricted to rupees. How much? How much DTA I am going to recognize? Whatever, that we have written no there. That is in the working note. How much we will recognize DTA? How much DTA will limit to? Can you tell me how much is the DTA? DTA is applicable on what? 30% on what? 3,000. That's what, okay. Subject, okay, we can write. If it's allowed, we can see. The question is a very silent there. You have to look into the question and you have to learn how to answer depending upon the circumstance. So we will say that 900, how did you get? 3,000 into 30%. It is restricted to 900. It is subject to. So question is very silent. So we will assume that no. In the given question, assumed, if you want, you can write, assume no tax planning opportunity also. That means if I assume that there is no tax planning opportunity also, then my deferred tax asset will be 900 rupees on 3,000. No, first of all, how much they told in the question, how much is the deductible? 4,000. Will you do 4,000 into 30%? Since it is a deductible, deferred tax asset is going to come. You will apply three conditions. Condition number 1, did it pass? What is the condition number 1? Condition number 1 is, when it is going to get reversed, it should have corresponding liability to offset. It doesn't have in the 4th year. That means 1000 is not supported by anything in the fourth year. When you estimated, today you estimated. Clear? You apply the second condition. Do you anticipate that in the fourth year will you make profits? No. Do you have any tax planning opportunities? No. Maybe then you can say no. See, if you are getting confused, see, this is the way ICA is doing. Let me say no, no, finish. No, finish. Because you are applying only one condition. Then here you write condition number 1, refer working note number 1, that reversible is not applicable. In the question only they told no profits are earned in the future, and assume that no tax planning opportunity also exists. That's why we restrict our deferred tax asset to 3000. Okay, what I will do, I will change this solution pattern as per whatever you like. Because see, I have went with the study material pattern. Study material, they have given S here with the star tax planning opportunities. And then they said, look, we will restrict it only to 3000. Yes, Prithvi, what is your doubt now? I want to understand what is your doubt. Huh? Okay, go through with it. So are you clear, students? So we are going to recognize the deferred tax liability on full 9,000 with the 2,700. However, we will limit and recognize deferred tax asset of only on 3,000 rupees. Right, third, no DTA on rupees 1,000 as future outlook is loss. But if tax planning opportunity available, DTA can be recognized. This is the discussion, no? This is like a discussion. We say that, look, we don't do recognition because there is a loss. But if you get any tax planning opportunity, yes, we will recognize 1,000 rupees on that into 30%. That also, 300 rupees also we will recognize. Yeah, maybe I may have to change the presentation. What I will do, I will change this presentation as per you ready-made for the examination. Yeah, because what I have done it with the study material pattern. So I am going to change it the way it is readily available for examination thing. So no, okay. Have you understood our discussion now? You are very clear? Yes. So we'll move on to the next question. Example number 44. An asset has a carrying amount of 100. So book value is 100. Tax base 60. This is an asset. So you have got a temporary difference. How much? 40. Is it taxable or deductible? Taxable. Now, the tax rate is 20% if you sell, that means capital gain tax, or 30% for other income. Now, my question to you is, are you going to recognize deferred tax asset or liability? Liability. Why? Because your book value is more than the tax base. Now, if you are going to recognize deferred tax liability, will you multiply 40 with 20 or 30%? That you say it depends upon the intention of the management. It depends upon the business model. What do you want to do with this asset? If you have planned to use it, today you recognize liability with 30%. Why? Because the moment you start planning to use it, you will earn the cash flow and you will show it as a revenue from operations. That's why for you tomorrow 30% is applicable. But today if you plan to sell it, what will come tomorrow? Capital gain is going to come. So today you recognize deferred tax liability with 20%. So it's a theory. The entity recognize 1 DTL at 20%, is equal to 40 into 20% is equal to 8. Deferred tax liability at 20% rupees 8. If it plans to sell, or DTL at 30% is equal to 40 into 30% is equal to 12 if it plans to use. That's it. So they may give all these things in one big problem. Huh? So you have to learn that how to write. Again, our format is simple. Asset carrying amount minus book value into tax percentage. Now, which percentage? It depends upon what you are intended to, what is applicable at the end of the first year, like that. These are all not important questions. We have, I think, see, till now we have discussed only 2 questions which is highly exam oriented. Can you tell me which is that? Which is highly probable for exam? One is that balance sheet 90 rupees and all moving. Second is the previous one. Discuss the 9,000 and 4,000 rupees. No, that can be a probable question. Other things are all for our understanding. An asset with the cost of 100, carrying amount is 80. So BV is 80. Revalued to be 150. So now BV became 150. No equivalent adjustment is made for tax purpose. So what is my tax base? As I told you, cumulative tax depreciation is 30. So 70. Tax rate is 30%. Followed, no? So my book value is 150. How did you get? 100 minus 20 rupees depreciation, it became 80, plus 70 revaluation surplus, it became 150. Taxation 100 minus 30 gives you 70. Now, if the asset is sold for more than the cost, that means how much? If you really sell at 150, the cumulative tax depreciation of 30 will be included in taxable income, but the sale proceeds in excess of the cost will not be taxable. Okay, what is this language? So how much you will be taxed? Depreciation part will be taxed. Revaluation is not taxed. So okay, okay. Now if you let us take a scenario. If you sell at 150, okay, what income tax is? How much deduction I'm going to get? If the asset is sold more than the cost, so you sold at more than the cost minus 100. Your cost is 100, no? So 50 is the profit. The cumulative tax depreciation of 30 will be included in the taxable income. That means in excess of that will not be taxable. So up to 30, you have to pay tax because that is the deduction I have given to you. More than whatever you income, just ignore it. It's a permanent difference formula. So today you may have such a big difference. How much? 80 rupees is the difference. Will you recognize how much deferred tax liability you are going to recognize? How much deferred tax liability you are going to recognize? Will you take into, okay, 30%? How much? Can you tell me, students, what is my deferred tax liability? If everything was normal, if this sentence was not given, okay, let us look into 2 ways. If this sentence is not given, you would have said straight away book value is 150, tax base is equal to 70, taxable temporary difference is 80 into 30% is equal to whatever, 24 rupees is the deferred tax liability. But what they said, look, in this 80, something you have sold, if you have sold more than the book value, then only up to 30 I will tax you in the future. So 30, that means even that revaluation is no use to you. 30 into 30%, 9 rupees is the deferred tax liability. Okay, but how to present this? Okay, again, this is an example. Solution. The tax base is rupees 70 and book value is rupees 150. There is taxable temporary difference of rupees 80. One, if it plans to use the asset, because if I go into the solution, that's what I told you, there is a catch. Question is very silent about whether you are going to sell or whether you are going to use it. And they have not told you two different percentage also. But in the solution, they have told you intention to sell, use and all story. So in the examination, they may add some namak, mirchi and all to it, telling that, oh, they have a plan to sell and all. So if you plans to use the asset, then how on deferred tax liability should come on what? 80. DTL is rupees 24. How? 80 into 30%. Then there is no question, no. How much is restricted, how much benefits and all. There is no question. Second, if it plans to sell, the sale value in excess of rupees 100, which is cost, is not taxable. That means today you have done revaluation of 80. Out of revaluation 80, you will be taxable only for those portion where you claim income tax deduction, 30 rupees. 50 is not taxable. So are you clear about this? Thus, excess sales of rupees 50, which is 150 minus 100, is not taxable. Therefore, DTL is equal to rupees 9. How did you get? 150 is the book value minus permanent adjustment is 70 minus tax base 50. This 50 is never taxable. No? Out of 150, 50 is never taxable. To the extent you claim the depreciation, you can pay into 30%. Yeah, because they may ask you in the examination telling some, they plan to use it, they want to sell it. Then if deferred tax asset comes, then you have to write those three conditions of the asset. Are you clear, students? Okay, no? Comfortable? Prithvi? Yeah, because again, you should feel that comfort for this, because we are going to apply this every often, no? Consultation and all, everything everywhere, but not that much theory and all we need not write. Next question, A Limited recognizes interest income in the books on accrual basis. However, for income tax, it is cash basis. Temporary difference? Temporary difference. On 31st December, interest receivable is 10,000 rupees. So what is the tax? This is where book value or tax base? Book value. What is my tax base? 0, because they accounted on cash basis. Now, will I get a deferred tax asset or liability? Liability, no? See, that's what I'm telling you. There are so many processes involved, but the point is, this is a so simple chapter. Once you understand it, just you can no need to do any analysis. Why deferred tax asset? Why deferred tax liability? What is my tax base? What happens in the income tax? Just if you grasp that, yes, you know that deferred tax liability is going to come because my book value is greater than the tax base. Now, tax rate was 25% on 31st December. Now, on 28th of February 2011, Finance Bill introduced the legislation that changed the tax rate to 30%. Now, question comes, will I multiply this? See, there is no dispute that whether it is a deductible or taxable, three conditions not applicable, because DTL means no three conditions. So, on 10,000, I have to multiply only. I have to recognize liability. But question is, will I do 25% which was there on 31st December, or will I do 30%? The finance bill was enacted on 21st of May. Discuss the treatment of deferred tax in case of the reporting of A Limited is 31st December and it approved the financial statement on 31st May. Yes. Now you have to remember what I discussed. But it is substantial, 28th February introduced, and in the exam they may say that the government has got a majority in the parliament, because in some of the question they have that language, and they have enacted also on 21st May. But will that my financials were approved after? Is it a subsequent event? Should I check that? Okay, which rate I should take? 25% or 30%? Obviously, because when I'm talking about a reversal, I have to consider future tax rates in mind today, not today's year, this year tax rate. But in this problem, the standard says, look, the tax rate, what you need to do, okay, Kriti was telling somewhere in between, it should be as on the reporting date. It should have been substantially enacted as on reporting date. The catch here is, yes, if we are talking about an Indian company whose reporting is 31st March, yes, you would have taken 30%. Look at the catch now here. What is your reporting date? Your reporting date is 31st December. On that day, you had any tax rates which is substantially enacted? No. So you are going to do it on 25% only. In examination, same question may come, because it has come in MTP also. Simply 31st December, no, they may change into 31st March. 30%. Why? Because by the end of the financial year, it is substantially enacted. Now they will add some more thing, that government had a majority there, somebody raised in the opposition that this tax is going to kill the poor. Some story they will tell. Don't get moved by that. You see, by 31st of whatever it is, your reporting period, is it substantially enacted? Or they may say that, look, 31st March only, you proposed 25% in the budget, but there was a considerable thing and the opposition party moved out and your government didn't have a majority. Then you have to consider 25%, because this act may not get passed, because the coalition team may get dissolved if this act is going to get passed. Followed, no? First April. Yeah. No, Baba, understood. See, here your catch here is, they said your closing year is 31st December. But by 31st December, they simply confused you. If it was 31st March, yes, what you said is correct. We would have considered 30%. Yeah. There is a mistake in the year also, because this should have been 31st, on 31st December 2011, it has interest receivable on 28th February 2012. Yes, correct. No, 11 only. Everything is perfect except this should have been 12, because by 31st March 2012 they approved it. And 31st December 2011 an approval happened 12. This should be 12. This is correct. Observation is right. Okay, right. They said discussed. So I said no. This should have been 28th of February 2012. There are no accidents. Huh? Please keep this in mind. It's the design. Okay, right. How to write in the exam? The difference of rupees 10,000 is of, okay, difference of book value 10,000 and tax base 0 is what? Because they asked you to discuss. Discussion means we should be very clear to the opposite party, telling our ideas. Taxable or deductible? Taxable. Thus, we need DTL, deferred tax liability, of rupees 2,500, which is 10,000 into 25%. We will not recognize DTL at 30% as by the end of 31st December 2011. 30% is not substantially inactive. Okay, I will read it my language, my handwriting. So we are telling that the difference is taxable temporary difference. We need to create a deferred tax liability of rupees 2,500 at 25%. The difference of 10,000 between the book value of 10,000 and tax base of 0 is taxable difference. And we have to create a deferred tax liability of rupees 2,500 at 25%. We have not considered 30% because by the end of 31st March December 2011, 30% is not substantially enacted. 30% is not substantially enacted. Written. However, if the effect is material, we need to disclose this. In the disclosures, we have to tell if it is material, but we cannot account at 30%. Yes, one last question. Done? Yes. This can be an RTP question. For me, I can say 4 marks. Entity has an identifiable asset called Asota, whose book value is 10 lakhs. Recoverable amount is 6,50,000. Tax, okay, what is the recoverable amount? Where you will use this terminology? Impairment. Recoverable amount is higher of fair value or value in use. Now, do you have any impairment? Yes, how much? 10 lakh minus 6,50,000. The tax base of the asset is 8 lakhs. Now, after impairment, what is your book value? 6,50,000. And the tax rate is 30%. Impairment losses are not tax deductible. Entity expects to earn the profits in the future. Huh? DTA. Yes, what is your opinion, others? How much others? How much? Do you need to calculate? How much? DTA, how much? Yes, I want Vishnupriya. What is this? See, this is what I want you to do at the end of my session, or if not, you have to practice. What you want to do is, by looking at the question, you should figure out, like, what is my book value here? Book value was 10 lakh minus impairment, which is 6.5. What is my tax base? 8. Why? Because that impairment what you deducted, they didn't allow it. So tax base is 8 only. Do you have a temporary difference? Yes, because it's going to get. It is a taxable or deductible? Deductible temporary difference. How much? 1.5. On this, which tax rates are you going to apply? 30%. Is there any substantial enactment and all? See, they can give you a mixed question. Huh? All these small concepts, they can chiller, they can put and give you. Now, on this, deferred tax asset is going to come. But before recognizing deferred tax condition, you have to apply 3 conditions. In that, any of the conditions fulfilled? Yes. Which one? That the profit is available in the future. Finish. No. So, yes, we will recognize full 45,000 rupees as a deferred tax asset. Are you clear, Prithvi? Dhanashree? Yes. So, how to write this if this question comes? As per Ind AS 36. Impairment is rupees 1,50,000. That is 8 lakhs. Sorry, not 1,50,000. 3,50,000. 10 lakhs minus 6.5. This is not tax deductible. Thus, book value of rupees 6,50,000 is less than tax base of rupees 8 lakhs. Are you clear? How do we explain? First we explain that, look, we recognized one impairment expense, because of which the book value came from 10 to 6.5, which is less than the tax base. Why? Because it is not tax deductible. We recognize DTA of rupees 45,000. How did you get this 45,000? 6.5 minus 8 into 30% as future profits are available. Future profits are available. Are you clear? That's it. See, this particular, we don't have any format as such, students. Problem is, that's the big problem. But your format is one thing, BV minus TB into tax percentage. This is your format. You have to just tell deferred tax asset or liability. Enough. If you explain like this, no, because almost all the questions are like this only. You have to calculate the tax and you have to explain it. Are you going to do it level liability or a asset? Yes. So with this, no, we have done the basic concepts of deferred tax asset or liability. An underlying theme is BV minus TB into tax percentage, which is substantially enacted on 31st March. And if it is the deferred tax asset, apply the condition. That's it. Yes. Now next we will see the impact of consolidation.